In the heart of America, far from Wall Street's flashing tickers and skyscrapers of glass, stands a quiet town called Omaha. It's not where you'd expect the world's greatest investor to be born. But that's exactly where this story begins, in 1930, during the Great Depression. A curious boy with a mind for numbers and a fascination with business. He sold Coca-Cola bottles door to door, bought his first stock at 11, and kept a notebook full of dreams. While others chased excitement, Warren Buffett chased understanding. He believed that behind every company was a story, behind every price, a truth. As the decades passed, the boy from Nebraska became a man the world would call the Oracle of Omaha. He built his empire not with greed, but with patience, not with noise, but with silence. From a small partnership of friends, he crafted Berkshire Hathaway, a fortress of cash flow and compound interest. He studied the wisdom of Benjamin Graham, mastered the art of value investing, and turned simplicity into a superpower. While others tried to predict markets, Buffett studied people, their emotions, their fears, their greed. He knew that real wealth was not made overnight. It was built in decades. Today, Warren Buffett sits among the richest humans to ever live, yet he still lives in the same Omaha house he bought in 1958. He eats breakfast from McDonald's, reads for hours each day, and walks to work with the calm of a man who already knows the ending. But what really lies behind that modest smile? How did he turn patience into profit and wisdom into one of the greatest fortunes in history? And what can we learn from the man who mastered time itself? This is the story of Warren Buffett, the quiet billionaire who changed the meaning of success. Welcome to Richie Rich Stories. This audiobook is based on true stories, but some events, characters, places, and conversations are fictionalized for dramatic purposes. The light from the Philco radio dial cast a gentle amber glow across the living room of 5202 Underwood Avenue. As 6-year-old Warren Buffett carefully counted his coins on the oak coffee table. Outside, the Nebraska winter wind rattled the windows, carrying the distant sounds of a city struggling through its fourth year of the Great Depression. Warren's small fingers, unusually dexterous for a child his age, sorted nickels from pennies with methodical precision. 25 cents exactly, he whispered to himself, a faint smile crossing his face as he dropped the coins into a small cloth pouch. Tomorrow morning, he would transform these coins into something more. Omaha in 1936 was a city of contrasts. While bread lines stretched around certain blocks and the shantytown on the city's edge grew with each passing month, the Buffett household maintained a fragile middle-class stability. Howard Buffett's small brokerage firm had survived the crash of '29 through caution and client loyalty, providing his family with comforts that had become luxuries to many. Regular meals, warm clothes, and a solid roof. Warren awoke before dawn the next morning, dressed quickly in the cold bedroom he shared with his sisters Doris and Roberta, and slipped out to his grandfather's grocery store. His grandfather, a sturdy man with kind eyes and calloused hands, nodded approvingly as Warren approached the counter. "Morning, Warren. Got your quarter?" Warren produced his cloth pouch. "Yes, sir." His grandfather reached beneath the counter and produced a wooden crate containing 6 glass bottles of Coca-Cola. "Here you go. Remember what I told you?" "Yes, sir. Buy for 25 cents, sell each bottle for 5 cents, 30 cents total, 5 cents profit." The older man smiled. "That's arbitrage, Warren, buying something and selling it for more, the beginning of all commerce." Later that morning, Warren set up his small operation on the porch of his grandfather's store, arranging the bottles precisely in 2 neat rows of 3. As the summer sun climbed higher, heating the sidewalks of Omaha, the cold bottles began to draw attention from passers-by. By noon, all 6 bottles were gone, and Warren had 30 cents in his pocket, a 20% return on investment in less than a day. That evening, as the Buffett family gathered around the radio to listen to one of President Roosevelt's fireside chats, Warren sat cross-legged on the floor, calculating in a small notebook how many bottles he could sell in a week, a month, a year. His father, Howard, noticing his son's absorption, smiled knowingly at his wife, Layla. "What are you working on there, Warren?" Howard asked during a pause in the president's address. If I sell 6 bottles every day for a year, I'll make $18.25 in profit, Warren replied without looking up. Howard exchanged glances with Layla. Their son had always been different, not interested in baseball or toy soldiers like other boys his age, but fascinated by numbers and the mysterious mechanics of money. That's if everything goes perfectly, Howard cautioned. In business, you have to account for unexpected costs, changing conditions. Warren nodded seriously. I'm accounting for days when it might rain. Later that night, Howard sat at the kitchen table, reviewing stock certificates by lamplight. Warren, supposedly in bed, appeared in the doorway in striped pajamas. Dad, can I see? Howard hesitated, then motioned his son over. These are preferred shares in Union Pacific. Do you know what preferred means? Warren shook his head. It means these shareholders get paid their dividends before common shareholders. Less risk. Howard's voice carried the measured tone he used with clients. The trick isn't just finding companies that make money, Warren. It's finding companies that will keep making money no matter what happens. The ticker-tape machine in Howard's small home office became Warren's first window into the mysterious world of capital flows. On Saturday mornings, while other boys his age played stickball in vacant lots, young Warren would sit beside the chattering machine, watching as it spooled out thin ribbons of paper marked with cryptic abbreviations and numbers. Each click and whir represented money moving invisibly across the country, abstract, yet somehow more real to him than the coins in his pocket. UP 18 1/4, AT&T 161 1/2, Warren would read aloud, following with his finger. That's Union Pacific Railroad up a quarter point, his father would explain patiently, and American Telephone and Telegraph up half a point. Why do people buy parts of companies instead of whole ones? Warren asked one afternoon, as autumn leaves swirled past the windows. Howard considered this. Most companies are too expensive for any one person to own entirely. By selling shares, they can raise money from many people to grow their business. Warren absorbed this, watching the ticker continue its mechanical dance. And the people who buy the shares, they become owners. That's right, partial owners. They take a risk by investing, but if the company does well, they share in the profits. Like my Coca-Cola business, Warren said, but I own all of it. Howard smiled. Exactly like that, son, just on a different scale. By 1941, as war spread across Europe and the economic machinery of America began to stir with military production, 11-year-old Warren had graduated from Coca-Cola arbitrage to more sophisticated commercial ventures. He delivered the Washington Post on his bicycle route, meticulously tracking his earnings. He sold used golf balls recovered from local courses, cleaned and sorted by quality. His room had become a miniature accounting office, with ledgers tracking every penny earned and spent. One evening in early spring, Warren entered his father's study with unusual hesitancy. Howard looked up from his desk, where he had been listening to radio reports of German U-boats threatening Atlantic shipping lanes. Dad, Warren began, his voice steady despite his nervousness, I want to buy stock. Howard raised his eyebrows. Stock? Which company? City Service Preferred. It's trading at $38 a share. I've saved $114 so I can buy 3 shares. Howard leaned back in his chair, studying his son. Why City Service? Their dividends have been consistent. The company has oil fields and utilities. People will need energy even during wartime, and, Warren hesitated, the price has been stable. Howard nodded slowly. Those are good reasons. But Warren, remember that the market can be irrational. Prices move for reasons that sometimes have nothing to do with a company's actual value. I understand, Warren said, with the seriousness of someone 3 times his age. The next day, father and son visited Howard's office downtown. The brokerage was a modest affair, a single room with a larger ticker-tape machine, a few wooden desks, and walls lined with financial reference books. Howard's secretary, Miss Wilmot, smiled at Warren as they entered. Good morning, Mr. Buffett, and good morning to you, young Mr. Buffett. Warren nodded politely, too focused on his mission to engage in small talk. Howard guided him to the trading desk. where he helped Warren complete the necessary paperwork to open his first brokerage account and place his order for 3 shares of City Service Preferred. "Now we wait," Howard explained. "The order will be executed and you'll become a shareholder." Warren slept poorly that night, his mind racing with visions of dividends and appreciation. The next morning, he rushed to check the newspaper's financial section before school, scanning the columns of numbers until he found City Service. The weeks that followed taught Warren his first harsh lesson in market psychology. Shortly after his purchase, City Service Preferred dropped from $38 to $27 per share. The paper loss of $33 represented months of saved allowances and earnings. Each morning, Warren would check the newspaper with increasing anxiety, watching his investment shrink. "The fundamentals haven't changed," Howard assured him. "The company is still sound." But Warren's 11-year-old nerves couldn't withstand the pressure. When the shares eventually rebounded to $40, he sold them immediately, relieved to have recouped his original investment plus a small profit of $6. Only weeks later, he discovered that City Service Preferred had continued climbing, eventually reaching $200 per share. The $6 profit he had gratefully accepted could have been a windfall of nearly $500, enough to buy a small house in some parts of Omaha at that time. That evening, Warren sat on the front porch swing, watching fireflies rise from the lawn as twilight settled over the neighborhood. Howard joined him, the wooden swing creaking gently under their combined weight. "I should have held on to those shares," Warren said quietly. Howard nodded. "Yes, but that knowledge is worth more than the money you missed." Fear and impatience are every investor's enemies, Warren. The market is a mechanism for transferring wealth from the impatient to the patient. Warren repeated the words silently to himself, committing them to memory with the same precision he applied to baseball statistics or stock prices. Patient, not impatient. His father was right. The lesson was worth more than the money. The summer of 1942 found America fully engaged in global war. Ration stamps, limited sugar, butter, and gasoline. Factory whistles sounded across Omaha as manufacturing pivoted to military production. Men in uniform became a common sight on city streets, and Gold Star banners began appearing in neighborhood windows. For Warren, now 12, the Omaha Public Library had become a sanctuary. The Carnegie-built structure with its imposing columns and hushed, book-scented reading rooms offered escape from the anxieties of wartime and entrance to worlds of knowledge. On a particularly hot July afternoon, Warren climbed the library's stone steps, nodded to Mrs. Henshaw at the front desk, and made his way to the business and finance section. The library's collection on investing was modest but sufficient. Perhaps 20 volumes ranging from basic primers to advanced text on bond valuation and corporate finance. Warren had already read most of them, but today he discovered a thin volume he had overlooked, The Theory of Investment Value by John Burr Williams. He carried it to his favorite oak table by the west window and began to read. Hours passed as Warren absorbed Williams's mathematical approach to determining intrinsic value. The concept resonated deeply. The idea that every business, regardless of its current market price, had a calculable real worth based on the future cash it would generate. As afternoon light slanted through the tall windows, Warren came across a passage that described compound interest as a snowball, rolling downhill, gathering size and momentum. Warren closed his eyes, visualizing this snowball. Start with a small core of capital, add layers through reinvested returns. Watch it grow exponentially as it rolls through time. The image crystallized something he had intuited, but never fully articulated: the awesome power of compounding returns over long periods. That evening at dinner, the Buffett family discussed the war news as they passed dishes of meatloaf and potatoes, meager portions reflecting wartime conservation efforts. "I've decided something," Warren announced during a lull in conversation. His parents and sisters turned to him curious. "I'm going to read every book on investing in the Omaha Public Library. Every single one." Doris, his older sister, rolled her eyes. "Of course you are." But Howard studied his son thoughtfully. "That's quite an undertaking." "Why?" "Because I need to understand how money works." Not just stocks going up and down, but the underlying principles. Warren's voice carried unusual conviction. I found something today, a metaphor about compounding being like a snowball rolling downhill, getting bigger the longer it rolls. Howard nodded slowly. That's an apt comparison. I want to start my snowball early, Warren continued, so it has a very long hill to roll down. Later that night, in the bedroom he shared with his sisters, Warren lay awake listening to the distant rumble of trains carrying war supplies eastward toward Atlantic ports. The household slept around him, his sisters' soft breathing, the occasional creak of settling floorboards. In this quiet moment, something solidified within him, not just an interest or hobby, but a defining direction. He would learn the rules of money. Not to show off wealth like some of the flashier families in Omaha, who drove new Packards and wore expensive clothes. No, Warren sensed that money represented something else entirely. Independence, security, and a kind of scorekeeping for decisions well made. The next morning, Warren rose early and opened a small notebook. On the first page he wrote, Rules for investment. 1. Be patient. 2. Know the intrinsic value. 3. Let compounding work. 4. Read everything. He stared at the page for a long moment, then added a fifth line. 5. Start early. Outside, the paperboy's bicycle rattled past, delivering the morning Omaha World Herald with its headlines of battles in distant oceans and foreign lands. Inside, in a modest bedroom on Underwood Avenue, a different kind of campaign was being mapped. Longer in timescale, quieter in execution, but ultimately no less consequential than the global conflict that dominated the world's attention in those final months of 1942. Warren closed the notebook and placed it carefully in his desk drawer. His snowball had begun its long roll downhill. The polished oak doors of Woodrow Wilson High School swung open, releasing a torrent of teenagers into the crisp autumn air of Washington, D.C. Among them walked a lanky, bespectacled boy with a gait that seemed more purposeful than his peers. Warren Buffett adjusted his glasses and checked his watch, a timepiece he meticulously tracked as a business expense. As afternoon shadows stretched across the manicured lawns of the Capitol, Buffett called a classmate. Coming to Kenny's malt shop? Bobby's dad got him a new Studebaker. Warren smiled politely, already calculating the opportunity cost of idle hours. Can't today. Papers won't deliver themselves. While other boys his age collected baseball cards or planned fraternity pranks, 15-year-old Warren collected something far more valuable, cash flow. The Washington Post route he had secured wasn't just an after-school job. It was an education in reliability, customer service, and the quiet power of compounding returns. Dawn would find him bicycling through Georgetown's cobblestone streets and the wide boulevards of Cleveland Park, the weight of newspapers balanced across his handlebars. His customers included senators, diplomats, and government officials whose breakfast tables weren't complete without the morning headlines about Truman's policies or updates from the European theater. Some mornings, frost numbed his fingers as he folded papers into tight cylinders, but Warren never missed a delivery. That evening, as most families gathered around their Philco radios to hear the latest war news, Warren sat at the dining room table in the Buffett household, meticulously counting bills and noting figures in a small ledger. His father, Congressman Howard Buffett, watched from the doorway. "Son," he said, his voice carrying the weight of the Nebraska plains they'd left behind, "most boys your age aren't filing tax returns." Warren looked up, his expression serious beyond his years. "Most boys my age won't have $6,000 saved by graduation either." The congressman nodded, understanding that his son possessed a particular kind of intelligence, not just book smarts, but a visceral comprehension of money's velocity. While Howard Buffett's politics centered on fiscal conservatism and gold-backed currency, his son was building something more personal, a philosophy of patient capital. In his bedroom that night, Warren sat surrounded by stacks of financial publications that other teenagers might have found impenetrably dull. Outside, searchlights occasionally swept the skies, a reminder of wartime vigilance even as the Allied forces gained ground in Europe. Warren barely noticed, absorbed in horse racing forms not for gambling, but for understanding probabilistic outcomes. The favorite doesn't always win, he murmured to himself, penciling calculations in the margins. And that's where the opportunity lies. The Buffett family's move to Washington in 1944 had coincided with a transformative period in American life. The capital was swollen with government workers, military personnel, and the apparatus of a nation conducting global war. Rationing remained a daily reality, with meat, butter, and gasoline all carefully allocated. Victory gardens sprouted in empty lots, and air raid drills were still conducted with solemn regularity. For Warren, however, the most exciting landscape wasn't the gleaming monuments or corridors of power, it was the economic ecosystem humming beneath it all. His paper route netted steady income, but it was merely the foundation. By 15, he had parlayed a $25 investment into a small empire of pinball machines, placed in local barbershops and stores. It's a simple business, Warren explained to his skeptical mother over breakfast. The machines cost me $25 each. I've placed 7 around town. The barbers keep half the revenue, I take half. The machines pay for themselves in months, and after that, it's pure profit. Leela Buffett studied her son, her expression a mixture of pride and bewilderment. Most mothers worried about their sons' grades or social lives. She found herself discussing depreciation schedules with a teenager. "And what will you do with the money?" she asked. "I'm thinking about farmland," Warren replied, spreading marmalade on his toast as casually as if discussing a movie at the cinema. 40 acres back in Nebraska. It's about $1,200, and I can lease it out. Cash flow, Mom. Cash flow. While classmates hung posters of Betty Grable or Glenn Miller in their rooms, Warren had pinned a property deed to his wall. His first parcel of Nebraska farmland, purchased with paper route savings. The land itself wasn't particularly distinctive. 40 acres of soil that would yield corn or soybeans in the reliable rhythm of the seasons. But what mattered was the lease income arriving with similar reliability. At school, Warren moved through the hallways like a visitor from another world. Academic subjects came easily enough when he applied himself, but his mind was often elsewhere, calculating yield rates or contemplating business improvements. He understood the social rituals of sock hops and football games well enough to navigate them, but rarely invested emotional capital in these ephemeral gatherings. His algebra teacher, Mr. Harrison, once stopped him after class. "Buffett, your test scores are excellent when you bother to study, but you seem distracted." Warren adjusted his glasses. "Sorry, sir, I was thinking about a business problem." "What kind of business problem could possibly be more important than quadratic equations?" the teacher asked with good-natured sarcasm. "I'm trying to decide whether to sell my pinball machine business or expand it," Warren replied earnestly. "I've been offered $1,200, which I could reinvest elsewhere, but there's also room for growth in the current operation." Mr. Harrison stared at his student, momentarily speechless. "You're running a pinball machine business?" "Yes, sir. 7 machines, 3 locations." The teacher cleared his throat. "Perhaps you should be teaching this class instead." By his senior year, Warren had developed a routine that would have exhausted most adults. Pre-dawn paper deliveries, school during daylight hours, machine collections and business planning in the evenings. While headlines blared about the Berlin airlift or Truman's struggling approval ratings, Warren quietly amassed capital and refined his understanding of what made businesses succeed or fail. In the spring of 1947, as cherry blossoms transformed the capital, most of Warren's classmates celebrated their imminent graduation by planning parties and comparing college acceptances. Warren celebrated by checking his savings passbook, nearly $6,000, a fortune for a 17-year-old in post-war America. University of Pennsylvania, his father announced proudly at dinner one evening, the Wharton School of Business, one of the finest in the country. Warren nodded, poking at his rationed portion of meat. "It's a good school," he agreed without enthusiasm. "You don't sound convinced," his father observed. "I'm sure I'll learn something," Warren replied, but doubt shadowed his voice. The elegant campus of the University of Pennsylvania welcomed Warren in the fall of 1947, its Gothic architecture and ivy-covered buildings, a temple to academic tradition. The Wharton School promised to mold the business leaders of tomorrow through rigorous study of economics, finance, and management principles. Within weeks, Warren found himself profoundly disappointed. "They're teaching theory from textbooks," he complained in a letter home. "Half the professors have never actually run a business. I'm not learning anything I couldn't teach myself." While his fraternity brothers debated football prospects or planned weekend diversions in Philadelphia, Warren retreated to the library, consuming investment literature that went far beyond his assigned coursework. Benjamin Graham's Security Analysis became his true textbook, its lessons about intrinsic value and market irrationality resonating more profoundly than anything his professors offered. By his sophomore year, Warren's discontent had crystallized into certainty. Wharton was the wrong place for him. The professors seemed to resent his questions, particularly when they exposed gaps in their practical knowledge. The curriculum felt divorced from the real business world he had already begun navigating with his pinball machines and farmland investments. Over Christmas break in 1948, Warren sat in his father's study in their Washington home, the weight of his decision hanging between them. "I want to transfer," he stated plainly, "to the University of Nebraska." Congressman Buffett studied his son, recognizing the calm determination that signaled an already made decision rather than a topic for debate. "You've given this thought?" he asked, though he already knew the answer. "I can finish my degree faster there. The professors at Wharton, Dad, I know more than some of them already, not about theory maybe, but about how money actually works." His father nodded slowly. "You've always charted your own course, Warren. If Nebraska is the right move, then that's where you should be." The University of Nebraska Lincoln campus lacked Wharton's architectural grandeur, but Warren felt an immediate alignment with its practical Midwestern ethos. The classrooms might have been plainer, the professors less prestigious, but the education felt more connected to the economic realities Warren had been studying since childhood. He accelerated his coursework, determined to complete his undergraduate degree in 3 years rather than 4. Even while carrying extra credits, Warren found time to deepen his investment knowledge, particularly his study of probability and statistical patterns. The racetrack became his laboratory, not for gambling, but for observing the inefficiencies of crowd psychology. On weekends, he would sometimes visit the local track, not to place bets, but to watch how the odds fluctuated, how the public's perception often diverged from mathematical reality. "See that horse?" he would explain to a confused classmate. "The odds show the public thinks it has a 20% chance of winning. But if you study its performance on similar tracks and against similar competition, the true probability is closer to 35%. That gap between perception and reality is where value hides." His classmate would inevitably ask, "So are you going to bet on it?" Warren would shake his head. "I'm not here to gamble. I'm here to understand how markets misprice assets. Someday, I'll apply this to businesses, not horses." By the spring of 1950, as tensions between the United States and the Soviet Union deepened into Cold War patterns, Warren Buffett completed his economics degree at Nebraska, finishing in 3 years what most students took 4 to accomplish. While headlines focused on the communist victory in China and the first Soviet atomic test, Warren focused on his next step, applying to graduate programs where he could further refine his investment philosophy. The night before his graduation, Warren sat alone in his modest student apartment, a financial statement from his bank spread before him. His savings had grown to over $9,000, a sum that represented not just frugality, but the disciplined application of business principles most people twice his age hadn't mastered. Outside, spring lightning illuminated the Nebraska sky in brilliant flashes. Warren barely noticed, absorbed in calculating compound returns and plotting his next move. While the world worried about atomic threats and ideological conflicts, the young man from Omaha had already identified his own North Star: the patient, rational accumulation of productive assets. His fingers traced across the deed to his farmland, the bank statements from his various enterprises. These weren't just possessions, they were the physical manifestation of a philosophy taking shape, one that would eventually reshape how the world understood value, patience, and the quiet power of compounded returns. Tomorrow he would graduate. Beyond that lay graduate school applications, new investment opportunities, and a world still recalibrating after global war. Warren Buffett closed his ledger book and switched off the lamp, content in the knowledge that he had already built something most people never achieve. A circle of competence, carefully drawn and thoroughly understood. The foundations were set. The rest would be a matter of time and patience. Two resources the 20-year-old investor had in abundance. The clock in Benjamin Graham's office ticked with quiet precision as Warren Buffett sat across from the investment sage, a single sheet of paper between them. Outside, the Columbia University campus was dusted with late autumn snow, students hurrying between buildings with collars turned up against the December chill. But inside this sanctuary of financial wisdom, Warren felt only warmth, the peculiar glow of recognition. An A+, Graham said, his voice measured, authoritative. The first I've given in my teaching career. Warren nodded, careful not to betray the rush of validation he felt. At 21, he had already absorbed The Intelligent Investor so thoroughly that its precepts had become part of his mental architecture. Margin of safety wasn't just Graham's principle, it had become Warren's North Star. I appreciate that, Mr. Graham, he replied, his Midwestern accent still pronounced despite his months in New York. Have you thought about what comes next? Graham asked, organizing papers on his desk. After Columbia, Warren had thought of little else. I'd like to work for you, sir, at Graham Newman. Graham's expression softened with something like regret. We typically don't hire non-Jewish analysts, Warren. It's not my preference, but it's the reality of the firm. The rejection stung, but Warren merely nodded. Disappointment was data, not defeat. He would return to Omaha, work at his father's brokerage, and wait for another opening in the fortress of Wall Street. The Dale Carnegie classroom on Fifth Avenue was filled with salesmen, middle managers, and young professionals, all battling the same demon that Warren confronted, fear of public speaking. The room smelled of wool suits, hair tonic, and nervous perspiration. Imagine them in their underwear, suggested the instructor, a silver-haired man with the enthusiastic demeanor of a revival preacher. Warren didn't find the advice particularly useful. His approach to problems was mathematical, not whimsical. But he had committed to the course, paying $100 he could ill afford because he recognized a critical truth. The best investment ideas were worthless if he couldn't articulate them. Mr. Buffett, the instructor called, your turn. 2 minutes on your hometown. Warren rose, heart hammering against his ribs. Perspiration dampened his collar as he made his way to the front of the room. He looked at the expectant faces, insurance men, appliance salesmen, secretaries seeking advancement, and found something unexpected, not judgment but solidarity. Omaha, he began, his voice barely audible. He cleared his throat and tried again. Omaha sits on the Missouri River, a city built by railroads and meat packers. By the end of his 2 minutes, Warren hadn't conquered his fear, but he'd faced it. In the months that followed, he would return each Tuesday evening, gradually building the communicative foundation that would later allow him to teach thousands of shareholders the principles of value investing. The Buffett Folk & Company office in Omaha was modest. A few rooms above a drugstore, the windows offering a view of the city where Warren had grown up delivering newspapers and selling gum. Now, at 21, he was a stockbroker, working on commission for his father's firm while he plotted his return to Graham's world. Northern Pacific, said Carl Jensen, a farmer who'd inherited money from his father. Everyone's buying it. My brother-in-law made 8% in 2 months. Warren removed his glasses, cleaning them methodically with his handkerchief. Outside, Omaha was deep in winter, the temperature hovering near zero, smoke rising from chimneys in straight columns before dispersing in the cold, still air. Mr. Jensen, I don't recommend Northern Pacific at current prices, Warren said. The railroad's earnings don't justify the valuation. You'd be paying for optimism, not assets. Jensen frowned. But my brother-in-law is operating on different principles than I am, Warren finished politely. I can't predict what the market will do next month or next year. I can only identify when a business is selling for less than it's worth. Jensen left without making a purchase, and Warren earned no commission. But he had remained faithful to Graham's principles. Buy with a margin of safety, never follow the crowd, know the difference between price and value. That evening, in his rented room, Warren read annual reports by lamplight, hundreds of pages of financial statements, looking for companies trading below their net working capital. His social life was nearly non-existent, while other young men his age were dating, dancing to Tony Bennett records, or watching I Love Lucy on newly purchased television sets. Warren was building an intellectual inventory that would serve him for decades. The New York Public Library was Warren's second home during 1951. Between classes at Columbia and his Dale Carnegie sessions, he would lose himself in Moody's manuals and corporate reports, methodically analyzing hundreds of companies, seeking those rare instances where market price diverged significantly from intrinsic value. On a spring afternoon, as cherry blossoms dusted the sidewalks outside, Warren sat opposite another Columbia student, a serious young man named Marshall Weinberg. "You're the one who got an A+ from Graham," Weinberg said. "Not a question, but a statement." Warren nodded, uncomfortable with recognition. "It's just a grade." "It's never just a grade with Graham," Weinberg replied. "Look, a few of us are starting an investment discussion group. Nothing formal, just sharing ideas. Would you join us?" Warren considered the invitation. He preferred solitary analysis, but he understood the value of intellectual exchange. When and where? Saturday afternoons, Walter's apartment on West 86th. That weekend, in a small apartment filled with cigarette smoke and debate, Warren found himself among kindred spirits, young men who spoke the language of price-to-earnings ratios and balance sheet analysis rather than baseball scores or Korean War strategy. "Western Insurance Securities," Warren said when his turn came, pushing his glasses up on his nose. "It's trading at 2/3 of book value with a solid underwriting history." The room fell silent, notebooks opened, pencils poised. Warren Buffett, the kid from Omaha with Graham's blessing, was speaking. They listened. The letter arrived in early 1954, delivered to the small desk Warren occupied at Buffett Falk & Company in Omaha. The envelope bore a New York return address he recognized immediately, Graham Newman Corporation. His hands were steady as he opened it, but his pulse was not. "Dear Warren," it read in Graham's precise handwriting, "a position has opened at the firm. If you are still interested in joining us, please telephone my secretary to arrange details." 3 years after the initial rejection, the door had opened. Warren placed the letter carefully on his desk, allowing himself a rare moment of satisfaction. The wait, the work at his father's brokerage, the meticulous study of companies, all of it had been preparation for this. He called New York that afternoon and accepted a starting salary of $12,000 per year. It was a substantial sum in 1954 when the average American worker earned about $3,000 annually. But Warren's focus wasn't on the money. Graham Newman was the Harvard of investment shops, and Benjamin Graham was its Einstein. The Graham Newman offices at 55 Wall Street were understated, bordering on austere. No mahogany paneling or leather chairs, just practical desks, filing cabinets, and telephones. The firm's philosophy of finding value in overlooked places extended to its own quarters. Warren arrived early each morning, often before the cleaning staff had finished, and stayed until the evening security guard made his rounds. He analyzed special situations, companies in liquidation, merger arbitrage opportunities, stocks trading below working capital, with the same intensity he had shown at Columbia. "Buffett," Graham said one afternoon, appearing beside Warren's desk, "what do you make of Philadelphia and reading coal?" Warren had studied the company thoroughly the previous weekend. "The preferred stock is interesting, Mr. Graham. If you liquidate the assets, it's worth significantly more than the current price, and the coal reserves provide a cushion against inflation." Graham nodded, betraying neither approval nor disapproval. "And the risks? Labor disputes could delay any liquidation value from being realized, and coal consumption patterns are changing as more homes convert to natural gas heating." "Good. Prepare a full write-up for the investment committee." These moments, presenting analysis to Graham and his partners, were Warren's equivalent of a young musician playing for a master. Each recommendation required exactitude, thoroughness, and a clear articulation of the margin of safety. On weekends, Warren often walked from his modest apartment in the East 50s down to Greenwich Village, where used bookstores offered financial texts at bargain prices. He had become known to several proprietors as the young man who bought only business books, never novels or poetry. "Mr. Buffett," said Morris Feldman, owner of a cramped shop on 4th Street, "I've set aside something you might appreciate." He reached beneath the counter and produced a first edition of Security Analysis by Graham and Dodd. Warren examined the book reverently. "How much?" $15. It was a week's worth of meals, but Warren didn't hesitate. The book was an investment in knowledge, and knowledge, properly applied, paid the best interest. That evening, in his sparsely furnished apartment, Warren read by the light of a single lamp, making notes in the margins. A transistor radio on the windowsill played softly, Patti Page singing, "How much is that doggy in the window?" The Korean War armistice had been signed the previous year. Eisenhower was in the White House, and the Dow Jones Industrial Average hovered around 280 points. Warren paid little attention to these macro events. His focus remained on individual businesses, their financial statements, and the gap between price and value. When he did consider the broader world, it was through the lens of Graham's teachings. Markets were voting machines in the short run, weighing machines in the long run. The noise of daily price fluctuations was just that, noise. "You've been with us a year now," Graham said, inviting Warren to join him for lunch at a small Italian restaurant near the office. "What have you learned?" Warren considered the question carefully. Outside, Wall Street bustled with messengers carrying securities between firms, traders hurrying to lunch appointments, and the general commerce of America's financial heart. Inside, the restaurant was quiet, tables covered with white cloths, waiters moving discreetly among the business clientele. "I've learned that emotional discipline matters more than intelligence," Warren replied finally. "The math isn't complicated. Finding bargains isn't the hard part. It's having the temperament to act when others are fearful and to resist when others are greedy." Graham sipped his water, watching his protégé with thoughtful eyes. "And what about your own temperament? Do you have it?" "I believe I do," Warren said without arrogance. "I'm comfortable being alone in my thinking. I don't need consensus to validate my analysis." Graham nodded. "That's rare, especially in someone your age. Most young men are desperate for approval, for confirmation they're doing the right thing." The conversation shifted to specific investments, but Warren carried the moment with him. A recognition from his intellectual hero that temperament, not just technique, distinguished the exceptional investor from the average. In his small apartment that evening, Warren sat at his desk, a legal pad before him. He was 24 years old, earning a good salary at Graham Newman, learning daily from the master of value investing. By conventional standards, he was successful. But conventional standards held little interest for Warren Buffett. He began to calculate. If he saved aggressively and achieved returns of 25% annually on his own investments, compounding over decades, where would that lead? The numbers grew exponentially on the page, mathematical poetry that spoke of future possibilities. Warren understood even then that the truly important decisions in life aren't about what you do, but about what you don't do. The temptations resisted, the distractions avoided. His Spartan apartment, his minimal social life, his indifference to luxury. These weren't sacrifices but choices that aligned with his vision of creating long-term value. Outside his window, New York continued its endless rhythm. Taxis honking, couples laughing as they walked to dinner, the distant wail of a siren. The city that never sleeps moved relentlessly forward. But in his quiet room, Warren Buffett was thinking decades ahead, seeing patterns and possibilities that would remain invisible to most until long after they had become reality. He closed his notebook, turned off the lamp, and sat in darkness, the city lights painting patterns on his ceiling. Tomorrow would bring more annual reports to analyze, more special situations to evaluate, more lessons from Graham. Each day was another brick in the foundation of what would become one of history's great financial edifices. But that was for tomorrow. Tonight, the young man from Omaha allowed himself a rare moment of reflection. The path was clear, the principles were sound, the temperament was his own. Everything else was just time and compounding. The light in Graham Newman's New York offices dimmed as winter afternoon shadows crept across Manhattan. Warren Buffett carefully slid the last folder into his briefcase, running his fingers along its worn leather edges. 2 years at Benjamin Graham's firm had given him precisely what he'd come for, a doctorate-level education in value investing taught by the master himself. "You're leaving early, Buffett," remarked Walter Schloss, looking up from a stack of annual reports. "Train to catch," Warren replied, going home to think. May 1956 found Warren back in Omaha, the spring air carrying the scent of new beginnings. The city seemed smaller after New York, but he found comfort in its familiar rhythms. Union Pacific trains rumbling through downtown, Mutual of Omaha's office workers filling local diners, and the steady Midwestern pace that allowed a man to hear himself think. He'd returned with $9,800 saved from his $12,000 annual Graham Newman salary, frugality being a virtue he'd never abandoned, and something far more valuable, conviction in a method. The question now was how to apply it. The living room of the modest house on Farnham Street felt cramped with 7 people seated in a semicircle. Warren, at 25, stood before them in a plain suit, a sheaf of typed papers in hand. These were not strangers but connections from his life. Dr. Edwin Davis, his wife's aunt and her husband, his sister and her husband, and his college roommate's mother. Trust was already established. What he needed was their faith in his method. "I appreciate you coming," Warren began, his voice steady but not theatrical. The Dale Carnegie course had polished his delivery without overwhelming his authenticity. "What I'm proposing is a partnership. I'll manage your money alongside my own, with our interests perfectly aligned." He explained the structure. Each limited partner would receive 6% annually before he took anything. Above that threshold, he would take 25% of the profits. His own stake was modest, just $100, but his promise was that every decision would be made as if his entire net worth were at stake. "I only get paid if you make money," he said, "and I only do well if you do very well." Dr. Davis leaned forward. "And how exactly will you invest our money, Warren?" Warren placed several company reports on the coffee table. I looked for cigarette butts with one good puff left. "Businesses trading below their working capital, special situations where a catalyst will unlock value. I don't predict market movements or use borrowed money. I buy dollar bills for 50 cents. The room was quiet, thoughtful. No one asked about his youth. They'd known him since his newspaper roots, his pinball machine business, his tax returns filed at 13. "I'm in for $10,000, Dr. Davis finally said. By evening's end, Warren had secured $105,000 total. The Buffett partnership was born. Autumn 1956 found Warren hunched over the desk in his home office, surrounded by Moody's manuals and stacks of annual reports. The house was quiet. His wife Susie had taken their 3-year-old daughter to bed. He'd developed a rhythm since launching the partnership, reading voraciously during the day, analyzing financial statements into the night. The window reflected his image as darkness fell outside. A young man with horn-rimmed glasses and thinning hair, who looked more like an accountant than someone who aimed to transform $105,000 into a fortune. Warren ran his finger down a column of figures for Commonwealth Trust Company of Union City, New Jersey. The stock traded at $50 while holding $125 per share in high-quality bonds. He smiled. This was Graham's classic net-net, a company selling below its liquidation value, offering a margin of safety thick enough to drive a truck through. He noted the position size in his ledger. Diversification was sensible, but conviction deserved capital. He would put 10% of the partnership's assets into Commonwealth. The Jefferson Hotel dining room hummed with the lunchtime conversation of Omaha's business establishment. Insurance executives, railroad men, attorneys. Warren sat across from Charlie Kaiser, business editor of the Omaha World Herald. "How's the partnership coming along?" Charlie asked, unfolding his napkin. "Quietly," Warren replied. "I prefer it that way." "Heard you've been studying Marshall Wells." Warren glanced up. "Where'd you hear that?" "Small town," Charlie shrugged. "You've been ordering annual reports, asking questions." Warren nodded. Marshall Wells was an old-line hardware wholesaler trading below its net working capital. The Dow had declined nearly 12% in 1957 as recession fears spread, creating precisely the environment where bargains emerged. "I'm studying a lot of companies," Warren said carefully. "Some are priced right now at significant discounts to their intrinsic values." "Markets got people spooked. Sputnik, the recession." "That's exactly when opportunity appears," Warren interrupted. "When headlines are negative, when fear prevails." The waiter arrived with their steaks. Warren's medium rare with hash browns, a meal that cost $2.75 and would remain his favorite for decades to come. "You sound like you want the market to fall further," Charlie observed. Warren cut his steak. "I'm not predicting anything, but when you're buying, lower prices are better. The stock market is the only store where customers run out when merchandise goes on sale." The Omaha winter of 1957 to 1958 was bitter, but Warren's small office stayed warm from the constant operation of his Underwood typewriter. He was drafting his second letter to partners, documenting the partnership's 10.4% gain for 1957. A year when the Dow had fallen 8.4%, meaning he had outperformed the market by nearly 19 percentage points. "Our performance, relatively, is less a matter of our superiority than the market's general lack of opportunity," he typed. "In a year when the market decline substantially exceeds intrinsic value deterioration, we expect to do relatively well." He paused, considering his next words carefully. He was establishing a philosophy that would guide decades of investing. "We do not consider ourselves to be forecasters of business or market fluctuations. If we were, we would have no advantage over anyone else. What we do consider ourselves to be is traders at discounts from underlying value. When this value becomes better defined through increased earnings, we expect to realize our profit." The letter continued with an explanation of his approach, focused on securities where he could determine value with reasonable accuracy, avoiding speculation, uninterested in technical market movements or economic predictions. This was his first real teaching moment. His partners needed to understand his method if they were to trust him through inevitable downturns. Spring 1958 brought both warming weather and a phone call from Ben Graham in California. "Warren, I'm dissolving the last of my partnerships," Graham said. "I thought you might want to know before my partners do." Warren leaned back in his chair. "Are you retiring completely?" "From active management, yes. I'll write, perhaps teach a bit, but I've made enough and I want to enjoy life." After they hung up, Warren sat thoughtfully. His mentor was walking away at 64, satisfied with a modest fortune and intellectual contribution. Graham had never been motivated by great wealth, only by solving the puzzle of value. Warren's ambitions ran deeper. He respected Graham enormously, but he was beginning to sense the limitations of his teacher's approach. Pure statistical cheapness was powerful, but franchise value, Munger would later call it wonderful businesses, remained underappreciated in the Graham framework. Still, for now, cigar butts served him well. The partnership had found Sanborn Map Company, a business that produced detailed maps for insurance companies. The stock traded around $45 while holding the securities portfolio worth $65 per share, effectively giving away the operating business for free. He'd begun accumulating shares. By 1959, Warren's routine was well established. He rose early, put on one of his 5 nearly identical suits, and drove downtown to the Omaha National Bank building, where he rented a small office for $175 monthly. The bank's trust department provided access to financial publications he couldn't justify purchasing himself. He spent hours there, methodically studying Moody's manuals page by page, looking for anomalies, companies trading below working capital, hidden assets, special situations. This particular afternoon, he was reviewing a probable merger between a small oil company and a larger conglomerate. The terms created an arbitrage opportunity, a small but nearly certain profit if the deal closed as expected. The partnership had begun establishing a position. His concentration was broken by the bank's trust officer, John Cleary, who stopped at his table. "Warren, you look like you found something interesting." Warren smiled. "Just a minor discrepancy between price and value. Must be working. Word is, you're up substantially this year." Warren nodded non-committally. The partnership had gained 25.9% in 1958, when the Dow rose 38.5%. His first year of underperformance, though still a strong absolute return. 1959 was shaping up better, with several special situations developing nicely. "I focus on process, not predictions," Warren said. "My goal is to make decisions I won't regret even if the outcome isn't immediately favorable." As Cleary walked away, Warren returned to his analysis. The partnership now managed over $300,000, still tiny by Wall Street standards, but growing steadily. 7 partners had become 11. His personal stake remained small, still under $10,000, but his percentage of profits was beginning to accumulate. That evening, Warren sat at the kitchen table with his wife Susie, the children already in bed. She was 30, vibrant and socially gifted in ways Warren was not, balancing his intensity with emotional intelligence. "How was your day?" she asked, pouring coffee. "Productive. Found an interesting situation. Commonwealth Life just announced they're selling their subsidiary at a price that exceeds their entire market cap." Susie smiled indulgently. "I meant, how are you feeling?" Warren paused, cup halfway to his lips. This was Susie's gift, redirecting his analytical mind toward emotional awareness. "I feel purposeful," he said finally, "like I'm building something that matters." "The partners trust you deeply," she observed. "That's a responsibility I take seriously," Warren nodded. "When they invested, many of them put in substantial portions of their savings. I owe them my best thinking, total transparency, and absolute integrity." "And yourself? What do you want from this?" Warren considered. "Financial independence, certainly. But more than that, I want to solve the puzzle. Capital allocation is a great intellectual challenge. Figuring out which businesses deserve investment and at what price, it's endlessly fascinating. And the money itself? Is scorecard and opportunity," he said. "Money itself doesn't interest me much. But what it represents, the freedom to think independently, to allocate resources rationally, that interests me enormously." Through the window, an Eisenhower-era Chevrolet cruised past their modest home. The neighbors likely assumed Warren was just another young professional finding his way. They couldn't see that inside this ordinary house, extraordinary mathematics were unfolding, the early compounding of what would become one of history's great fortunes. December 1959. Warren sat alone in his office late one evening, reconciling the partnership's positions. The year had been excellent, up approximately 40% when the Dow had gained about 20%. In just over 3 years, the original $105,000 had grown to more than $500,000. His personal stake, through the profit-sharing arrangement, was approaching $100,000. He'd developed routines and principles that would serve for decades. Never use leverage. Focus on what you can analyze, not what's popular. Be greedy when others are fearful, fearful when others are greedy. Don't lose money. The telephone rang, unusual for this hour. "Buffett Partnership," he answered. "Warren, it's Dan Monin," said the Omaha attorney who had helped structure his partnership. "Just had dinner with Henry Brandt. He mentioned he has some capital to invest." Warren knew Brandt, a successful local businessman who could potentially invest $50,000 or more. "I appreciate the referral, Dan, but I'm not looking for new partners right now." "He's good for it. Substantial means." "It's not about his capital," Warren explained. "It's about expectations. I need partners who understand my approach, who won't panic if the market drops or pressure me to chase hot stocks. I'm building something for the long term." After hanging up, Warren returned to his ledger. The partnership was still small, but its trajectory was becoming clear. His method worked. Patience, rationality, and a focus on intrinsic value rather than market sentiment were creating above-average returns. Outside, Omaha settled into winter stillness. Christmas lights twinkled on houses along the tree-lined streets. Inside, Warren Buffett continued writing figures in his precise handwriting, each entry a small step toward what would become an extraordinary journey, one whose ultimate destination even he could not yet imagine. The morning light poured through the office windows, casting long shadows across the hardwood floor. Warren Buffett sat alone, methodically reviewing pages of reports, the quiet rustle of paper the only sound in the early hours. Outside, Omaha stirred to life in the crisp autumn of 1960, but inside this sparse office, a different kind of awakening was taking place, the steady, relentless compounding of capital that would soon become legendary. At 30 years old, Warren had the serious demeanor of a man twice his age, his wire-rimmed glasses and conservative suit belying the revolutionary approach to investment he was refining. The partnership he had started in 1956 was now entering its 5th year, and the results spoke with eloquence. Nearly 30% annual returns, while the broader market limped along at less than a third of that pace. "You don't need to swing at every pitch," he murmured to himself, setting aside a prospectus for a fashionable electronics company that had recently caught Wall Street's fancy. The go-go years were beginning to simmer, but Warren remained immune to their fever, his investment philosophy a quiet rebellion against the prevailing wisdom. That evening, he drove his modest Volkswagen through Omaha's streets, passing the extravagant homes of those who displayed their wealth more conspicuously. The radio hummed with news of Kennedy's presidential campaign against Nixon, promises of a new frontier, space exploration, and renewed American vigor. Warren listened with the detached curiosity of a man who found politics interesting but markets essential. At home, his wife Susie greeted him with a warm smile that immediately softened his analytical countenance. Their children scampered about, the domesticity a counterpoint to the cerebral intensity of his workday. "The market's getting frothy," he told Susie later that night as they sat in their modest living room. "People confuse bull markets with brilliance." "And you?" she asked, knowing him better than anyone. Warren's smile was faint. "I'm looking for value where others see only ashes." In 1962, as America held its collective breath during the Cuban Missile Crisis, Warren continued to amass positions in undervalued companies, undeterred by the possibility of nuclear annihilation. His partnership letters to investors maintained their calm, reasoned tone, even as televisions across the country showed Kennedy addressing a nation on the brink. "If Kennedy and Khrushchev blow up the world tomorrow," he remarked dryly to his small office staff, "our investment decisions won't matter much anyway." The crisis passed, but Warren's methodical approach never wavered. His partnership swelled with new capital as word of his extraordinary returns spread through a network of Omaha doctors, lawyers, and business owners. They found reassurance in his unconventional promise he would eat his own cooking, putting his family's money alongside theirs, and taking nothing unless he first delivered results above a 6% threshold. "I won't get paid for mediocrity," he told a prospective investor, a wealthy grain merchant who had driven in from Lincoln. "The partnership has to earn its keep." The man studied Warren's unassuming office. No mahogany, no pretension, just function. "You're not like those New York fellows," the merchant observed. "No," Warren agreed, "I'm not. I sleep better that way." On a crisp morning in 1963, Warren sat in his office reviewing the financial statements of a textile manufacturer named Berkshire Hathaway. The New Bedford, Massachusetts company was struggling. A fading relic of American industrial might now besieged by cheaper Southern competitors, and the looming threat of overseas production. But the balance sheet told a story that interested him. The stock traded well below the liquidation value of its assets. The phone on his desk rang sharply, interrupting his concentration. "Warren, it's Charlie Munger." The voice belonged to the Los Angeles lawyer he had met in 1959. Though their relationship was still developing, Warren found himself increasingly drawn to Charlie's sharp mind and philosophical approach to business. "Charlie, good to hear from you. What's on your mind?" Just wondering if you've been watching this textile company you mentioned last time. Berkshire? Looking at it right now, actually. And? Book values there. The business itself is marginal at best. Classic cigar butt, one good puff left. Charlie's laugh crackled through the line. You know, there's something to be said for wonderful businesses at fair prices rather than fair businesses at wonderful prices. Warren paused, rolling the thought around. Maybe, he acknowledged, but right now the price on this one is too compelling to ignore. After hanging up, Warren returned to the Berkshire Hathaway statements, but Charlie's words lingered. The seed had been planted, though it would take years to fully germinate. November 22nd, 1963, arrived like any other day but ended as a national watershed. Warren was reviewing insurance company statements when his secretary burst in with news that would freeze the nation. President Kennedy had been shot in Dallas. The office fell silent as they gathered around a small television, watching Walter Cronkite remove his glasses to announce that the president was dead. Markets closed early. Business seemed suddenly trivial. That evening, Warren sat alone in his study, the television muted as it showed endless replays of the motorcade, the hospital, the swearing in of Lyndon Johnson aboard Air Force One. He found himself thinking not of politics, but of mortality and legacy, what one builds that might endure beyond a life suddenly cut short. The next day, as the nation mourned, he wrote in his journal, "The market will fluctuate, companies will rise and fall, but value, real value, should be the North Star." By 1964, the Buffett partnership had grown to nearly $40 million in assets. Warren's reputation was spreading beyond Omaha, though he maintained his deliberate distance from Wall Street's frenetic pace. His annual letters to partners became increasingly philosophical, outlining not just results but principles. The importance of margin of safety, the irrationality of markets, the virtue of patience. "I am not in the business of predicting general stock market or business fluctuations," he wrote in his 1964 letter. "If you think I can do this or think it is essential to an investment program, you should not be in the partnership." This forthrightness attracted a certain kind of investor, those who valued long-term thinking over quick gains, who understood that compounding worked its magic most powerfully when left undisturbed. Spring 1965 brought a defining moment. Warren had accumulated a significant position in Berkshire Hathaway over the previous 2 years, drawn by its deeply discounted price relative to assets. The company's president, Seabury Stanton, had verbally offered to buy back Warren's shares at $11.50 each. "We have a deal," Warren had told him over the phone. But when the formal offer arrived by mail, the price had been trimmed to $11.38 per share, a difference of just 12.5 cents. Warren sat at his desk, the letter in hand, a curious mix of emotions stirring within him. The rational analyst in his mind knew the price difference was negligible, but something else. Pride, perhaps, or a visceral response to what felt like a slight, kindled a different reaction. Instead of selling, he began buying more aggressively, eventually taking control of the company. It was a decision made partly in cold calculation, partly in hot blood, a rare instance where emotion colored his investment approach. On a rain-slicked evening several weeks later, Charlie Munger called again. "So you now own a textile mill," Charlie observed, his tone carrying a hint of amusement. "I do. May I ask why?" "I saw an opportunity to acquire assets below their intrinsic value," Warren said finally, the standard language of value investment only partially masking the truth. "Sometimes," Warren continued, "even when you apply sound principles, the execution can be imperfect." "Well," Charlie replied with characteristic directness, "a textile mill in New England is fighting the tide of history. Southern mills have lower labor costs, and soon enough, overseas production will undercut them all." "I'm aware," Warren acknowledged, "but the price was right, and now we have a vehicle we can use. Berkshire gives us a corporate structure we can reshape over time." After the call ended, Warren remained at his window, watching raindrops trace patterns down the glass. Charlie wasn't wrong. The textile industry faced structural headwinds no management skill could fully overcome. It was a lesson he was beginning to internalize. Bad economics trumps good management every time. Yet within this mistake, a larger opportunity was taking shape. Berkshire Hathaway could become more than a textile company. It could become a holding company, a vehicle for capital allocation on a scale beyond what his partnership structure allowed. By late 1965, Warren had begun shifting Berkshire's focus, using its cash flow to acquire an insurance company that offered something more valuable than textiles. Float, premium dollars that could be invested before claims needed to be paid. In his office on a December afternoon, he studied the tax code with the intensity of an archaeologist deciphering an ancient tablet. The partnership structure had served him well, but its limitations were becoming apparent. Berkshire offered a different model: permanent capital, tax advantages, and the ability to reallocate resources across businesses without triggering tax events. On his desk lay two documents: Berkshire's latest disappointing textile division report and the promising financials of the insurance acquisition. Side by side, they told a story of transition from asset-based value investing to the acquisition of cash-flowing businesses. The winter light was fading when his secretary announced his last appointment of the day, a longtime partner seeking reassurance about the Berkshire acquisition. "Why textiles, Warren?" the older man asked after settling into the chair across from him. "Everyone says manufacturing is moving south or overseas." "The textile operation itself isn't the prize. Think of Berkshire as a corporate shell we can fill with better businesses over time." Still seems like an odd way to start. Yes, perhaps. But even in mistakes, there are opportunities to learn and adapt. He replaced his glasses and leaned forward slightly. "I've been thinking about the partnership structure, its limitations. Berkshire gives us options we wouldn't otherwise have." "You've always played the long game. It's the only game worth playing," Warren replied. After the investor left, Warren returned to the window, watching as streetlights flickered on across Omaha. The city had changed little in his lifetime: solid, dependable, unhurried. He found comfort in its constancy, even as his own vision expanded far beyond its boundaries. The Buffett partnership had defied conventional wisdom for nearly a decade, generating returns that most investment professionals considered impossible to sustain. Yet Warren knew something they didn't. Patience and discipline weren't just virtues, they were competitive advantages in a market dominated by short-term thinking. As 1965 drew to a close, Warren Buffett stood at a crossroads. Behind him lay the remarkable success of his partnership. Ahead, the uncharted territory of transforming a failing textile company into something entirely different. The textile mills of Berkshire Hathaway would continue their slow decline for years to come. A costly reminder that price alone wasn't enough, that the economics of the underlying business mattered profoundly. But within this expensive lesson lay the foundation for something far greater: a corporate structure that would one day become synonymous with patient capital, ethical management, and the power of compounding returns over decades rather than quarters. Outside, snow began to fall on Omaha, covering the city in a pristine blanket of white. Warren watched the flakes swirl in the glow of street lamps, each one insignificant alone, yet collectively transforming the landscape, not unlike the investment philosophy he was refining, where small advantages, consistently applied over time, could accumulate into something remarkable. The coffee in Warren Buffett's office had gone cold, just like the market. Outside his window, Omaha's winter sky hung low and gray, a fitting backdrop for his thoughts on the frenzied Wall Street of 1968. He studied the financial statements spread before him, searching for value that seemed increasingly elusive. "Too expensive," he murmured, setting aside yet another prospectus. The go-go years, they were calling them, a market driven by speculation rather than fundamentals. The Nifty 50 stocks commanded price-to-earnings ratios of 40, 50, even 60 times. Buffett knew bubbles. He'd studied them, written about them in his partnership letters, avoided them. Charlie Munger's voice echoed in his mind from their last conversation. "This isn't investing anymore, Warren, it's gambling." At 48, Warren Buffett had accomplished what most would consider a lifetime achievement. Since 1956, his investment partnership had delivered returns. That dwarfed market averages, 29.5% compound annual growth versus the Dow's 7.4%. The farm boy who'd started with newspaper roots now managed millions. Yet something troubled him as he gazed at the market's dizzy heights. The principles that had guided him, margin of safety, intrinsic value, rational price, seemed increasingly irrelevant in a market caught in speculative fever. "Warren," his assistant appeared at the doorway. "Your partners are waiting in the conference room." He nodded, gathering his papers. The decision had been forming for months. Today, it would become real. The partners sat quietly as Buffett explained his thinking. These were doctors, lawyers, teachers, entrepreneurs, friends and family who had entrusted their capital to his stewardship. Their expressions shifted from confusion to concern as his message became clear. "I'm dissolving the partnership," he said, his voice steady but soft. "I'll be liquidating our holdings and returning your capital." A stunned silence filled the room. Dr. Edwin Davis, one of his earliest believers, finally spoke. "Warren, we're up over 20% this year. Why now?" Buffett removed his glasses, polishing them with a handkerchief, a gesture that had become a thinking ritual. "Because I can't find value anymore," he said simply. "The kinds of opportunities I understand are disappearing. When I can't allocate capital intelligently, the honest thing is to return it." "But surely there must be something worth buying," insisted Tom Newman, a dentist who'd invested with Buffett since 1957. "There's always something to buy," Buffett acknowledged, "but not at prices that make sense. I won't compromise our principles just to stay active." He outlined his recommendations. Those seeking professional management should consider Bill Ruane's new Sequoia fund. Ruane was brilliant, honest, and shared Buffett's investment philosophy. Others might consider index funds, a passive approach gaining traction thanks to John Bogle at Vanguard. "But what will you do, Warren?" asked Dorothy Davis, Edwin's wife. A slight smile crossed his face. "I'll be focusing on Berkshire Hathaway." Few in the room fully understood the significance of that statement. Most viewed Berkshire as Buffett's mistake, a struggling textile operation fighting imports and synthetic fabrics. None could envision it would become the vehicle for his greatest achievements. As the meeting concluded, partners approached one by one, some to thank him, others seeking reassurance. Buffett answered each with patience and characteristic Midwestern directness. The dissolution would be complete by 1970. Walking alone to his car afterward, he felt a curious lightness. The burden of finding a home for so much capital in an overvalued market had been lifted. He was giving up millions in potential fees, but gaining something more valuable, freedom to wait for the fat pitch. By early 1970, Warren Buffett had shed the partnership structure that had defined his career for 13 years. Now chairman and CEO of Berkshire Hathaway, he sat in his modest office contemplating his next moves. The textile business continued to struggle, but Berkshire offered something the partnership couldn't: permanent capital. "No more redemptions to worry about," he told Susie over dinner in their unpretentious house on Farnham Street, the same house they'd bought in 1958 for $31,500. Susie studied her husband's face. "You seem more at peace." "I am," he admitted. "For the first time in years, I don't feel pressured to buy something just because the money's sitting there." The market was beginning to crack. The Dow had already fallen from its 1968 high of 985 to the 700s. Nixon's presidency was consumed by Vietnam and growing inflation. The economic miracle of the post-war years was showing strain. Buffett was watching, waiting. He'd transformed himself from a pure Graham-style bargain hunter into something more sophisticated, influenced by Munger's insistence that quality businesses at fair prices outperform fair businesses at wonderful prices. "I'm thinking differently now," he told Charlie during one of their marathon phone calls. "The textile operation is teaching me what not to buy. We need businesses with moats, sustainable competitive advantages." "Like See's candies," Munger suggested. "Quality that customers will pay premium prices for." "Exactly. Capital-light businesses that grow without consuming cash. Pricing power, brand strength." These conversations were shaping what would become Buffett's mature investment philosophy, a synthesis of Graham's margin of safety and Munger's quality emphasis. The framework was crystallizing: understandable businesses, durable competitive advantages, honest management, reasonable prices, and capital-light growth potential. In 1972, he found See's Candies. The California chocolate maker commanded fierce customer loyalty and operated with minimal capital needs. When the owners named their price, $30 million. Buffett initially hesitated. It was 3 times book value. That's a lot to pay for a candy company, he told Munger. It's not about the buildings or equipment, Charlie replied. It's about the brand. People in California would rather skip Valentine's Day than give something besides See's. Buffett ultimately offered $25 million and got the deal done. The lessons would prove invaluable. See's would generate over $2 billion in cash for Berkshire over the coming decades while requiring minimal reinvestment. It became his case study in the power of intangible assets. But the true test of his evolving philosophy came in 1973, as the Watergate scandal engulfed Richard Nixon's presidency. The stock market, already weakened, began a severe decline that would ultimately cut the Dow nearly in half. Rain streaked the windows of the Graham family building in Washington, D.C., as Katharine Graham, publisher of the Washington Post, welcomed Warren Buffett into her office. At 56, Kay Graham carried the weight of a newspaper under fire. Nixon's administration had targeted the Post for its Watergate reporting. Government advertisers were being pressured to pull their business. "I appreciate you coming, Mr. Buffett," she said, gesturing to a chair. "Warren, please," he replied, setting his worn briefcase beside him. "I've been an admirer of the Post for years." Graham studied the unassuming man opposite her. With his off-the-rack suit and simple haircut, he looked more like an accountant than one of America's most successful investors. "You've been buying our stock," she observed. "Yes, about 10% of the company so far. May I ask why? We're not exactly popular with this administration." Buffett smiled slightly. "That's precisely why. The Post stock is selling at about a quarter of what the assets are worth." Assets? The newspaper, the television stations, Newsweek. But more importantly, the Post has something money can't easily buy: journalistic integrity and a community that depends on it. Graham's expression softened slightly. "We're facing significant pressure." "Short-term pressure," Buffett corrected. "But the Post has a durable competitive advantage, what I call a moat. You're essential to Washington. Advertisers need you more than you need any single advertiser." By the end of their meeting, Buffett had committed $10.6 million to the Washington Post Company, approximately 10% of the outstanding shares. The investment represented a significant evolution in his thinking. He was paying for quality, for institutional strength, for the intangible power of a trusted brand. "I'd be honored to serve on your board if you'd find it helpful," he offered as they concluded. Graham, who had initially been wary, found herself warming to this plain-spoken investor. "I would appreciate that, Warren." Neither could have predicted their investment relationship would evolve into one of the most important friendships of both their lives, nor that Buffett's $10.6 million would eventually grow to be worth over $1 billion. Back in Omaha, as 1973 gave way to 1974, Buffett watched the market's continued decline with the detached interest of a naturalist observing an inevitable cycle. The Dow, which had reached 1,051 in January 1973, was plummeting towards 600. Stagflation gripped the economy, the unprecedented combination of high unemployment and high inflation that defied traditional Keynesian remedies. Gas lines formed as the OPEC oil embargo quadrupled petroleum prices. Nixon's wage and price controls failed to contain inflation. The Watergate hearings dominated television. America seemed to be unraveling. "This is exactly what we prepared for," Buffett told his small Berkshire team. "When others are fearful, we have capital ready." While most investors retreated in panic, Buffett deployed cash methodically. Beyond the Washington Post, he accumulated shares in media companies, insurance operations, and consumer businesses with pricing power. On a cold December evening in 1974, with the Dow hovering near its nadir of 577, Buffett sat in his study working on notes for a Forbes article he'd been invited to write. The thesis was simple: stocks represented extraordinary value. "Look at these prices," he muttered to himself. American Express at 5 times earnings, Gillette at 7 times, General Foods at 6 times. These aren't just good businesses, they're great businesses selling like mediocre ones. He picked up a photograph on his desk, his original partnership team from 1957. Many had stayed with him all the way until the 1969 dissolution. They'd accepted his recommendation to move to Sequoia Fund with Bill Ruan, avoiding the 1973 to 1974 crash. Buffett had protected them by acknowledging his limitations, by refusing to pretend he could find value in an overheated market. Now, vindicated by the crash he'd anticipated, he was positioned to capitalize on once-in-a-generation bargains. His phone rang, Charlie Munger calling from California. "Warren, tell me you're buying with both hands," Charlie said without preamble. "Every day," Buffett confirmed, but patiently, selectively. "This is our moment," Munger said. "This crash is separating the professionals from the amateurs." Buffett nodded, though Charlie couldn't see him. "The partnership dissolution was the best decision I ever made. If I'd still been managing all that money with partners who could withdraw, I'd be forced to liquidate positions right now instead of buying." "Permanent capital," Charlie mused, "the structural advantage nobody talks about." As they ended the call, Buffett looked out at the winter night settling over Omaha. The market's fear had created the opportunity he'd been waiting for. By closing his partnership in 1969, he'd not only protected his investors from the crash, but positioned himself to emerge from it far stronger. Berkshire Hathaway, once his worst investment, had become his perfect vehicle. The struggling textile operations continued to generate headaches, but they now shared a corporate umbrella with insurance companies providing float, media assets with pricing power, and consumer businesses with beloved brands. The foundation was being laid for what would become an extraordinary business empire. The discipline to walk away at the market's peak in 1969 had created the freedom to run toward opportunity when others fled in 1974. Warren Buffett turned back to his desk and continued writing his Forbes piece, articulating the case for stocks when few wanted to hear it. The article would eventually become famous for its memorable conclusion: "Now is the time to invest and get rich." For Warren Buffett, the discipline to resist greed would prove more profitable than greed itself ever could. The rain tapped against the windows of Berkshire Hathaway's modest Omaha headquarters, a counterpoint to the steady tick of the clock on the wall. Warren Buffett sat alone in his office, surrounded by stacks of annual reports and financial statements, a half-finished cherry Coke on his desk. Outside, the mid-1970s America was caught in the grip of stagflation, inflation above 10%, unemployment approaching double digits, an energy crisis that had Americans waiting in long lines at gas stations. Warren stared at the numbers before him, the red ink bleeding across the textile division's quarterly report. Berkshire Hathaway, the company he'd acquired a decade earlier in what he now considered a moment of emotional peak, continued to struggle in its original business. The New England textile industry was dying a slow death, unable to compete with foreign imports. "I almost quit," he murmured to himself, running a hand through his thinning hair. It was 1975, and for a man whose earliest business instincts had been so unerringly accurate, the textile operation represented a rare and persistent miscalculation. Charlie Munger, his intellectual partner and vice chairman, had been characteristically blunt during their last conversation. "The textile business is doomed, Warren," Charlie had said over dinner at Gorat Steakhouse, cutting into his medium-rare T-bone. "You know it. You know it. I know it. The only question is when you'll finally admit it." Warren hadn't argued. The rational investor in him knew Charlie was right. Yet, something else, a sense of obligation to the workers who had been with the company for decades, kept him from pulling the plug. "Another 10 years," he had replied quietly. I'll give it another decade. Charlie had arched an eyebrow, but said nothing more. Now, alone with his thoughts, Warren recognized the tension between his investor's rationality and his steward's conscience. He opened his desk drawer and pulled out a letter he'd been drafting to shareholders. These annual letters had evolved over the years from simple financial summaries to something more: lessons on business, investment philosophy, and the psychology of markets. The telephone rang, interrupting his reverie. "Mr. Buffett, Jack Byrne is on line 1. Warren picked up immediately. Byrne was the CEO of Government Employees Insurance Company, the insurance company Warren had first invested in decades earlier as a young man. Now Government Employees Insurance Company was on the brink of bankruptcy, hammered by underwriting losses and regulatory pressures. "Jack, what's the situation?" Byrne's voice was strained but controlled. "It's not good, Warren. The regulators are breathing down our necks. We need capital, and we need it fast." Warren nodded to himself. He'd been watching Government Employees Insurance Company's troubles with concern, but also with the calculated patience of someone who understood both the insurance business and the cyclical nature of markets. "How much do you need?" "To survive and turn things around, 40, maybe 50 million. There was a pause on the line. "For half the company," Warren said finally. It wasn't a question. "Yes," Byrne replied, "for half the company. I'll be in Washington tomorrow." As he hung up, Warren felt a familiar clarity. While most investors fled from distress, he recognized that Government Employees Insurance Company's problems were operational, not terminal. With the right management, and Jack Byrne was the right management, the company could recover. More importantly, he understood something that few others did: the true power of insurance float. The next morning, a cold January day in 1976, Warren flew to Washington, D.C. The country was still reeling from Watergate and Nixon's resignation. The mood in the Capitol reflected the national malaise that would later be diagnosed in Jimmy Carter's famous speech. But Warren wasn't thinking about politics. His mind was on Government Employees Insurance Company and the opportunity it presented. By evening, the deal was done. Warren had committed $45.7 million for 50% of Government Employees Insurance Company, a massive bet that represented a significant portion of Berkshire's capital. It was the kind of decisive move that defied conventional wisdom, but aligned perfectly with his investment philosophy: be fearful when others are greedy, and greedy when others are fearful. Back in Omaha, in the same modest house on Farnham Street he purchased in 1958 for $31,500, Warren sat at his kitchen table with his first wife, Susan. She was preparing to leave for San Francisco to pursue her singing career, an unconventional arrangement that nonetheless worked for them. "You bought half of Government Employees Insurance Company," she said. "Not quite a question. I did. The same Government Employees Insurance Company you've loved since you were 20. Warren smiled slightly. "The very same. It's a better company now than it was then, just temporarily troubled." Susan nodded, understanding. She had always grasped the essence of her husband's investment approach: look for fundamentally sound businesses selling at a discount due to temporary problems. "And the textile mills?" she asked. Warren's smile faded. "I'm keeping them open, for now." She reached across the table and squeezed his hand, knowing the decision cost him both financially and emotionally. The Government Employees Insurance Company investment proved transformative. Under Jack Byrne's leadership, the company stabilized, then thrived. More importantly, it crystallized Warren's understanding of the insurance business model. Premiums came in up front, while claims were paid later. In the meantime, that float could be invested. If underwriting was disciplined, if the insurance operation could break even or generate a profit, then the float was essentially cost-free or even negative cost capital. It was financial alchemy of the highest order. By the early 1980s, as Reagan's presidency ushered in a new era of economic optimism, Berkshire Hathaway had evolved into something unique: a holding company with permanent capital, no redemptions, and the ability to compound float and operating earnings in a tax-efficient wrapper. Insurance had become the engine that powered Warren's investment vehicle. In his sparsely furnished office, no computer, just telephones and reading material, Warren composed his 1983 annual letter. Outside, the economy was roaring back from the brutal 1981 to 1982 recession. Inflation was falling. The Dow had broken through 1,000 and was climbing steadily, and "greed is good" was becoming the unofficial mantra of Wall Street. Warren, in his characteristic off-the-rack suit and sensible shoes, seemed increasingly out of step with the flashy excesses of the era. But his letters were finding a growing audience, not just among Berkshire shareholders, but in the wider investment community. He wrote with unusual clarity, avoiding jargon and lacing his explanations with homespun metaphors and wry humor. When we own portions of outstanding businesses with outstanding managements, our favorite holding period is forever, he wrote, the keys of his IBM Selectric clacking steadily. His phone rang. It was Mrs. B. Rose Blumkin, the indomitable Russian immigrant who had founded the Nebraska Furniture Mart and sold it to Berkshire in 1983 with nothing more than a handshake agreement. "Warren, you come see new carpet display," she commanded in her thick accent. At 90, she still worked 7 days a week. "I'll be there this afternoon, Mrs. B," he promised. Warren smiled as he hung up. Mrs. B exemplified the kind of business owner he sought to partner with, fiercely independent, obsessed with value, and possessing unimpeachable integrity. His approach to management had solidified around a simple philosophy: hire for integrity, intelligence, and energy, then get out of the way. "If you hire the right people, you don't need to manage them," he often said. "Just allocate capital and stay out of their way." By 1984, Warren's approach to capital allocation had become methodical. Each year, the cash generated by Berkshire's operating businesses and insurance float was directed to one of four uses: reinvestment in existing businesses, acquisition of new businesses, purchase of minority stakes in public companies, or, rarely, dividends or share repurchases. The textile operation continued to struggle, a persistent reminder of the importance of underlying economics. No management, no matter how skilled, could overcome the fundamental disadvantages of a commodity business with high labor costs competing against foreign manufacturers. Finally, in 1985, Warren made the decision that had been inevitable for a decade. Berkshire would close its textile operations. It was a somber day when he visited the mills in New Bedford, Massachusetts, to deliver the news personally. The factory floors, once bustling with the rhythmic clatter of looms, would soon fall silent. Workers whose families had been employed there for generations listened gravely as Warren explained the economics that had made this outcome unavoidable. "I kept them open 10 years longer than I should have," he admitted to Charlie Munger later that evening over the phone. "That's not good capital allocation." "It was a valuable lesson," Charlie replied in his characteristically direct manner. "One you won't repeat." That same year, Forbes magazine published its annual list of the 400 richest Americans. Warren appeared for the first time as a billionaire, his net worth estimated at $1 billion. The milestone passed with little celebration in the Buffett household. He still lived in the same house, still ate at the same restaurants, still played bridge with the same friends. His public persona as the Oracle of Omaha was solidifying. The contrast between his Midwestern frugality and the excesses of Wall Street creating an irresistible narrative for the financial press. Yet those who knew him understood that his thrift wasn't an affectation. It was authentic, rooted in the belief that happiness came not from consumption, but from freedom and the pursuit of one's passions. In October 1987, the financial world trembled. On a single day, Black Monday, the Dow Jones Industrial Average plummeted 22.6%, the largest one-day percentage drop in history. Panic gripped Wall Street, fortunes evaporated, margin calls cascaded through the system. Warren remained calm. In Omaha, far from the hysteria of Wall Street, he recognized the crash not as a calamity, but as an opportunity. When others were paralyzed by fear, he acted decisively, deploying capital to purchase shares in businesses he understood at prices suddenly much more attractive. His 1987 letter to shareholders, written in the aftermath of the crash, contained no hysterics, no dire predictions, only a measured assessment of Berkshire's position and a reaffirmation of his long-term approach. "We have no idea, and never have had, whether the market is going to go up, down, or sideways in the near or intermediate-term future," he wrote. "What we do know, however, is that occasional outbreaks of those two super-contagious diseases, fear and greed, will forever occur in the investment community. The timing of these epidemics is equally unpredictable. Our goal is more modest. We simply attempt to be fearful when others are greedy, and to be greedy only when others are fearful." As the decade drew to a close, Berkshire Hathaway had been transformed. What had begun as a struggling textile company was now a diversified holding company with insurance at its core. The Nebraska Furniture Mart, See's Candies, the Buffalo News, and significant stakes in companies like Capital Cities/ABC and Coca-Cola formed a collection of businesses with durable competitive advantages, or moats, as Warren called them. Book value per share and operating earnings were compounding at rates that far outpaced the broader market. The float from the insurance operations had grown to hundreds of millions of dollars, providing capital for further investments. And Warren's annual letters had become essential reading for investors worldwide, dispensing wisdom on business, markets, and the psychology of investing. In his office, as rain once again tapped against the windows, Warren reflected on the journey from the textile mill acquisition to the conglomerate Berkshire had become. The Geico investment, the discovery of the insurance float mechanism, the painful but necessary decision to exit textiles. Each had been a crucial step in the evolution of his investment approach. Outside, the world was changing rapidly. The Cold War was thawing, technology was advancing, Wall Street's influence on American business and culture was ascendant. But in his modest office in Omaha, Warren Buffett remained steadfast in his principles. Focus on intrinsic value, invest in businesses you understand, and approach the market with rationality rather than emotion. The Oracle of Omaha had found his rhythm, and the dance was just beginning. Snow was falling over New York City on a cold December evening in 1988 as Warren Buffett gazed out the window of his modest hotel room. The crystalline flakes drifted past the glass, illuminated by the city lights below. At 58, the Omaha investor's unassuming appearance, wire-rimmed glasses, rumpled suit, and off-the-rack haircut belied the weight of the decision he was contemplating. $1 billion. The sum whispered in his mind as he turned back to the financial statements spread across the bed. Coca-Cola's annual reports, market analyses, and consumption data from around the world formed a mosaic that told a story few others could read with such clarity. Quality at a fair price, he murmured to himself, a mantra that had gradually replaced his earlier hunting of cigar butts, near-dead companies with one good puff left in them. The Graham philosophy that had served him so well was evolving into something more refined. The telephone rang, interrupting his thoughts. It was Charlie Munger, his intellectual sparring partner for decades, calling from California. "You still staring at those Coke numbers?" Charlie asked, his voice tinged with amusement. "The world consumes over 600 million servings of their products every day," Warren replied, tracing his finger along a chart showing international growth trends. "And that number keeps climbing. So you're going to pull the trigger." $1 billion worth, Warren confirmed, almost a quarter of our float. There was a momentary silence on the line. Not exactly a small position. "The brand is the moat," Warren said. "Distribution, pricing power, global recognition. They've built something that can't be replicated for any reasonable sum. And the management. Goiswitter knows what he's doing, ROIC consistently above 20%. After hanging up, Warren returned to the window. The Berkshire Hathaway he had inherited, a struggling textile manufacturer purchased out of spite in 1965, was now an insurance-centered conglomerate with a stock price above $4,500 per share. The company would never split its shares. It wasn't interested in attracting investors who focused on share price rather than business value. By 1991, the Coca-Cola investment was already proving its worth. The stake had grown considerably in value, vindicating Warren's conviction that great businesses compounded intrinsic value year after year with minimal additional capital. On a summer afternoon, Warren found himself in Seattle at the home of mutual friends. He had been reluctant to attend what he'd expected to be just another gathering of wealthy people discussing vacation homes and art collections. But his host, Catherine Graham of the Washington Post, had insisted. "There's someone I want you to meet," she had told him. That someone was Bill Gates, the 35-year-old founder of Microsoft, already worth billions as the personal computer revolution transformed American business. Warren approached the meeting with mild curiosity but modest expectations. The two men found themselves seated next to each other at dinner. Warren expected polite conversation. What unfolded instead was an intellectual connection that surprised both of them. "I don't use computers," Warren admitted with a self-deprecating smile. "My investment in IBM consists of exactly one electric typewriter." Gates laughed. "And yet you understand business models better than most technology CEOs, I know." Their conversation quickly deepened, moving from technology to mathematics to probability and game theory. Warren found himself impressed by Gates's analytical precision and mental agility. Gates, in turn, was struck by Warren's ability to distill complex business situations into simple, first-principle assessments. As dessert was served, they were still engrossed in conversation. "What about bridge?" Warren asked. "Do you play?" Gates's eyes lit up. "I do. My parents taught me when I was young." "We should play sometime," Warren said, finding another unexpected connection. After dinner, they moved to a quiet corner of the living room while other guests mingled elsewhere. The conversation turned to books and reading habits. "How many hours a day do you read?" Gates asked. 5 or 6, usually," Warren replied. "Always have. I'm still working through the same encyclopedia set I started when I was 5. "I take reading vacations," Gates said. "A week at a time, just me and a stack of books." As the evening wound down, both men realized something rare had happened, a connection based on mutual respect and shared intellectual curiosity rather than business opportunity. Warren had met someone whose mental intensity matched his own, albeit in a different domain. It was the beginning of a friendship that would deepen over the coming years, expanding Warren's network beyond the financial world and later enabling philanthropic possibilities neither could yet envision. The morning light filtered through the windows of Warren's office in Omaha in autumn of 1993. The room was notably sparse. No Bloomberg terminal, no computers, no electronic tickers. Just stacks of annual reports, newspapers, and a landline telephone that connected him to a world where billions moved on his decisions. His assistants brought in a cup of cherry Coke and a fresh copy of the Wall Street Journal. On his desk sat the prospectus for Dexter Shoe Company, a Maine-based manufacturer that had caught his attention with its consistent profitability and domestic manufacturing prowess. The telephone rang. It was Charlie again. "You're going to buy the shoe company," Charlie said without preamble. "Thinking about it," Warren replied, glancing down at his notes. "Consistent earnings, good management, reasonable price." "How are you paying?" A moment of hesitation. "Berkshire stock." The silence on the other end was weighted with rare disapproval. "You think our currency is fairly valued?" Charlie finally asked. "The deal works at $433 million, Warren answered, sidestepping the question. "Their earnings justify it." "If you pay with dollars, you're risking dollars," Charlie said. "If you pay with Berkshire stock, you're risking what those shares might become over the next 20 years. Warren tapped his pencil against the desk. Charlie's concern was valid. Berkshire shares were still dramatically undervalued relative to their intrinsic worth. Using them as currency meant sacrificing future compounding on each share given away. "I believe in Dexter's durability," Warren said, though with less certainty than usual. After they hung up, Warren walked to his window overlooking Omaha. The city had been good to him, a place where thinking could happen without the constant noise and distraction of Wall Street, a place where living in the same modest house for decades raised no eyebrows. He knew the Dexter purchase wasn't his standard play. He typically preferred businesses with unassailable competitive positions. Shoes were, well, shoes. But the American manufacturing angle appealed to him, and the numbers looked sound. What he couldn't see, what no one could see in 1993, was how quickly Asian manufacturing would transform the economics of footwear production. The competitive landscape would shift beneath Dexter's feet more rapidly than anyone anticipated. Years later, he would call it one of his worst mistakes, not because the business failed, but because he paid with undervalued Berkshire stock. The real cost wasn't the $433 million, but the billions those shares would have been worth had he kept them. Snow was falling again in December 1998 as Warren's car pulled up to Berkshire's headquarters. The final weeks of the year had been consumed with the largest acquisition in Berkshire's history, General Re, a reinsurance giant, for approximately $22 billion. In the quiet of his office, Warren reviewed the details of the transaction with a growing sense of discomfort. General Re's derivatives book was far more extensive than his preliminary examinations had indicated. 23,218 contracts across the spectrum of financial instruments. The notional exposure approached $6 billion. Warren removed his glasses and rubbed his eyes. The derivatives themselves weren't the problem. It was their complexity and opacity that troubled him. The contracts were nearly impossible to value accurately, with counterparty risks that couldn't be fully assessed. His telephone buzzed. "Ajit Jain is here to see you," his assistant announced. "Send him in." Ajit entered, carrying a thick folder of papers. As Berkshire's reinsurance genius, he had been reviewing the General Re acquisition with his characteristic thoroughness. "You've seen the derivatives exposure?" Warren asked without preamble. Ajit nodded, his expression serious. "It's a mess, Warren. Thousands of contracts with indeterminate risk profiles. Some extend more than 20 years into the future. Can we unwind them?" "Slowly. Expensively. But yes." Warren's decision crystallized in that moment. "Start the process. I want every one of those contracts closed out or allowed to expire naturally, no new positions." "It could take years," Ajit cautioned, "and cost hundreds of millions to exit." "Better than keeping them," Warren replied. "These instruments contain systemic risks that even their creators don't fully understand." Later that evening, alone in his office with the snow still falling outside, Warren began drafting notes for his next shareholder letter. The General Re derivative situation had clarified something that had been troubling him for years: the growing disconnection between financial engineering and underlying business reality. He wrote a phrase that would later become famous: financial weapons of mass destruction. The complexity and leverage embedded in derivatives created risks that couldn't be properly assessed until it was too late. The financial system was building hidden fragility that would only be revealed in crisis. Warren leaned back in his chair, thinking about the contrast between these complex instruments and the businesses he preferred, those that could be understood in a single sentence. See's candies, premium chocolate sold at a premium price. Coca-Cola, sugar water with unparalleled brand loyalty. Government employees' insurance company, low-cost auto insurance sold directly to careful drivers. The simplicity wasn't just aesthetic, it was protective. When you understood a business completely, you could evaluate how it might perform across different economic scenarios. When even the creators of financial instruments couldn't fully grasp their mechanics, disaster lurked beneath the surface. By the time he left the office that night, Warren had crystallized another core principle: avoid complexity, avoid leverage, avoid what you don't understand. The General Re derivatives would eventually cost Berkshire $404 million to unwind and would require nearly a decade to fully exit. An expensive lesson that only strengthened his conviction. The mid-1990s brought a subtle evolution to Berkshire's acquisition strategy. Warren found himself receiving more inbound calls from family business owners seeking a permanent home for companies they had built over generations. On a crisp autumn day in 1996, he sat across from Richard Broadhead, the third-generation owner of a Midwestern manufacturing company with steady cash flows and a dominant regional position. "Why Berkshire?" Warren asked, genuinely curious. You've had offers from private equity firms at higher multiples than what we discussed. Broadhead looked out the window at the Nebraska landscape before answering. Those firms would load us with debt, cut our workforce in half, then flip the company in 5 years. That's not what my grandfather built this for. Warren nodded, understanding completely. And when we buy businesses, we keep them forever. That's what I'm looking for, Broadhead replied. Someone who will preserve the culture and let the company continue to grow naturally. This conversation, variations of which happened with increasing frequency, reflected the growing Buffett premium. Sellers would accept lower prices to become part of Berkshire because they valued certainty and cultural preservation over maximum dollars. Warren found himself thinking about this phenomenon as he walked through his neighborhood that evening, hands in his pockets, enjoying the familiar sights of the same streets he had lived on for decades. His approach to business had always been different from Wall Street's conventional wisdom. No retainer-earning investment bankers, no quarterly earnings guidance, no stock splits to make shares more affordable, no leverage to juice returns. The restraint that Wall Street viewed as eccentricity, or worse, as leaving money on the table, was precisely what attracted certain kinds of business owners to Berkshire. They recognized that long-term thinking could create value that short-term optimization destroyed. As the 1990s progressed, and the market climbed ever higher on the back of emerging technology stocks and increasing leverage, Warren maintained his discipline. He avoided the burgeoning internet sector entirely, drawing occasional criticism for missing the new paradigm. "I don't invest in things I don't understand," he explained repeatedly at annual meetings. "And I don't understand how companies with no profits and no clear path to profitability can be worth billions." Some called him out of touch, too old to grasp the new economy. Yet Warren's restraint wasn't born of confusion but of clarity. The dot-com valuations violated first principles he had spent decades refining. Instead of chasing momentum, he focused on businesses with sustainable competitive advantages, reasonable valuations, and straightforward economics. The foundation he laid during these years, consolidating his philosophical approach around simplicity, transparency, and durability, would serve as a bulwark against the financial storms gathering on the horizon. While he couldn't predict exactly when the reckoning would come, Warren positioned Berkshire to weather whatever arrived. As the century's end approached, the Buffett way stood in stark contrast to prevailing financial trends. Avoid complexity when others embrace it, maintain liquidity when others leverage, seek durability when others chase novelty, prioritize understanding over speculation. These weren't just investment principles but a worldview, one that acknowledged the limits of forecasting and the value of patience. In a financial landscape increasingly dominated by algorithms and abstract financial engineering, Warren remained stubbornly focused on businesses that produced real goods and services for willing customers. It wasn't glamorous, but it was sustainable, a quality that would prove invaluable when the financial tides eventually turned. The late September light fell soft and amber across the mahogany desk in Warren Buffett's unpretentious Omaha office. Outside, the trees that lined Farnham Street had begun their autumnal transformation, a slow-motion ballet of green giving way to gold. Warren adjusted his wire-rimmed glasses and studied the financial statements before him with the same meticulous attention he'd given to thousands before. "Charlie," he said into the speakerphone, his voice carrying the measured cadence of the Midwest, "what do you think about this insurance float? We're approaching 50 billion. On the other end of the line, Charlie Munger, Warren's intellectual sparring partner of decades, cleared his throat. "It's remarkable what happens when you compound discipline over time," he replied, "though I suspect the hard part is still convincing people we're not wizards, just patient." Warren allowed himself a small smile. At 71, the Oracle of Omaha found himself at an inflection point. The wealth he had accumulated through Berkshire Hathaway had grown beyond any reasonable personal need. The question that increasingly occupied his thoughts wasn't how to make more money, but how to give it away with the same effectiveness that had marked its accumulation. The millennium had turned, bringing with it the spectacular collapse of the dot-com bubble. Warren had watched from the sidelines as the Nasdaq plummeted, wiping out trillions in paper wealth. His warnings about derivatives as financial weapons of mass destruction seemed prescient now, in the aftermath of the Enron and WorldCom accounting scandals that had shaken investor confidence to its core. "You know what Kipling said," Warren mused, half to himself. "If you can keep your head when all about you are losing theirs." The intercom buzzed. "Mr. Buffett, Bill Gates is on line 2. Warren picked up the handset. "Bill, how are you?" "Just landed in Omaha," Gates replied. "Still on for bridge tonight?" "Wouldn't miss it. Astrid's making that apple pie you like." Their friendship had deepened over the years since their first reluctant meeting in 1991. What began as a conversation between two successful businessmen had evolved into something more meaningful, a partnership of minds that increasingly turned toward philanthropy. They shared a common belief. Wealth of this magnitude carried responsibility. Later that evening, as the autumn chill settled over the city, Warren's modest house on Farnham Street hosted a gathering that would have astounded those who imagined how billionaires lived. No opulent displays of wealth, just a comfortable home where Bill and Melinda Gates joined Warren and his then-wife Susan for an evening of bridge, conversation, and apple pie. Between hands, the discussion turned to giving. "The question isn't whether to give," Warren said, studying his cards, "but how to give well. Maximum impact." He placed a card deliberately on the table. "Money is like manure. Pile it up and it stinks. Spread it around and it does a lot of good." Bill nodded thoughtfully. "It's harder than making it in some ways. The metrics for success are less clear." "That's why I admire what you're doing with the foundation," Warren replied. "You're applying the same analytical rigor to giving that you did to software." What remained unspoken that evening was Warren's growing conviction that the bulk of his fortune, now in the tens of billions, should flow to philanthropy rather than to his children. He had already begun seeding family foundations. The Susan Thompson Buffett Foundation, named for his first wife, the Howard G. Buffett Foundation for his son, the Sherwood Foundation, and the Novo Foundation. Each had its focus: education, agriculture, women's empowerment. But something larger was taking shape in his mind. The terrorist attacks of September 11, 2001 had shaken America's sense of security. Warren watched as the country embarked on wars in Afghanistan and Iraq, as the Patriot Act expanded government surveillance, as the nation's attention turned outward toward threats real and perceived. Through it all, he maintained his focus on what he understood best: businesses with intrinsic value, run by trustworthy people. On a crisp morning in November 2003, Warren's assistant handed him a letter from a family in the Midwest. They owned a manufacturing company. 3 generations, privately held, profitable but not flashy. "They're looking to sell," she explained. "They specifically asked for you, said they don't want a private equity firm dismantling what they've built." Warren nodded. This was happening more frequently now. His reputation as a buyer who preserved rather than dismantled had spread among family businesses concerned with legacy. No bankers, no auctions, just a direct approach from owners who had built something of value and wanted to see it continue. He called the CEO directly that afternoon. 20 minutes into their conversation, Warren had made his decision. "I think we understand each other," he said. "Send over your financials and let's talk numbers." His process remained remarkably streamlined for someone overseeing a conglomerate approaching 100 billion in value. Read the 10K. Call the CEO. Decide quickly within his circle of competence. Avoid auctions. Pay fair prices for good businesses. The principles hadn't changed since he bought his first shares of Geico decades earlier. The network of relationships that fed Berkshire's growth had matured into a well-defined ecosystem. Ajit Jain had become indispensable in insurance operations, his disciplined underwriting allowing Berkshire to take on risks that others couldn't or wouldn't. Greg Abel was building the energy and infrastructure portfolio. The Rolodex of investment bankers, Goldman Sachs, Allen & Company, Lazard, knew to bring certain kinds of opportunities directly to Omaha. In 2004, Susan Thompson Buffett, Warren's first wife and closest confidant, despite their unconventional marriage, passed away. Her death prompted a period of reflection for Warren. The architecture of his philanthropic vision began to take clearer shape. He spoke more frequently with his children about their foundations, about responsibility, about values. "It's not just about giving money away," he told his daughter Susie one evening. "It's about giving it away intelligently." Most of philanthropy is well-intentioned, but not particularly effective. His relationship with Bill and Melinda Gates had evolved into a partnership in giving. He admired their foundation's approach, data-driven, focused on measurable outcomes, willing to take on seemingly intractable problems like malaria and polio. The idea was forming that perhaps his fortune could accelerate their work rather than establishing yet another major foundation. As 2005 unfolded, the American housing market continued its seemingly unstoppable rise. Warren watched with growing concern as subprime lending proliferated, as mortgage-backed securities and collateralized debt obligations multiplied, as rating agencies blessed financial instruments they scarcely understood. "Charlie," he said during one of their regular calls, "I'm seeing the same speculative excess we saw in 1999, just in a different arena." "The four most dangerous words in investing," Munger replied dryly. "This time it's different." Warren nodded, though Charlie couldn't see him. "We're storing dry powder. There will be opportunities when this turns." His phone rang more frequently now, with opportunities and crises alike. Warren had become something of a financial statesman, a voice of reason and stability in an increasingly frothy market. Berkshire's Fort Knox balance sheet, with its massive cash reserves and absence of leverage, positioned the company as a potential rescuer when liquidity might suddenly evaporate. On a flight back to Omaha from New York, Warren made notes on a yellow legal pad. He was sketching the framework for what would become his historic pledge, the commitment to give away more than 99% of his wealth, primarily through annual gifts of Berkshire stock to the Gates Foundation and family foundations. The structures would be lean, staff-light, focused on specific problems rather than general good intentions. The plane banked gently over the Missouri River as it began its descent. Warren looked out at the patchwork of farms and neighborhoods below, at the city where he had been born during the Great Depression and where he had built one of the world's great fortunes. The landscape of his life stretched out in geometric patterns, as orderly and logical as a balance sheet. There was something poetic, he thought, in the circular journey of capital, from the fertile soil of American enterprise, gathered through patient investment, returned ultimately to address human suffering and expand opportunity. Not a revolution, but perhaps an evolution in how wealth might serve larger purposes. As the wheels touched down on the runway, Warren closed his notebook. The next phase was taking shape, setting the structure for an unprecedented transfer of wealth from private fortune to public good. There were details to work out, announcements to prepare. But the decision itself had been made with the same clarity that had guided his investments, a calculation not just of financial returns, but of human ones. "We've landed, Mr. Buffett," the flight attendant said softly. Warren nodded, gathering his things. The metaphor wasn't lost on him. One journey ending, another beginning. The most consequential allocation of capital in his long career lay just ahead, not an investment in a business, but an investment in humanity's possibilities. The terminal building glowed warm against the darkening prairie sky as he made his way across the tarmac. In Omaha, the evening lights were coming on, steady and reliable as compound interest. The summer of 2006 arrived in Omaha with its familiar Midwestern warmth, the morning light filtering through the trees onto Warren Buffett's modest house on Farnham Street, the same home he'd purchased for $31,500 in 1958. Inside, Warren sat propped against pillows in the master bedroom, newspapers spread across the covers as he conducted his daily ritual of absorbing information from the Wall Street Journal, Financial Times, the New York Times, and Omaha World Herald. The morning was significant, though nothing in his demeanor revealed it. At 75, with a fortune exceeding $40 billion, Warren had finalized the decision he'd contemplated for years. Today, he would announce that more than 99% of his wealth would go to philanthropy, primarily through annual gifts of Berkshire Hathaway stock to the Bill and Melinda Gates Foundation. He sipped his cherry Coke, the carbonation crackling softly in the quiet room. The beverage, a long-time favorite, represented one of his many profitable investments in consumable American brands. His wife, Astrid, had already left for her sculpture studio, leaving him to prepare for what would become one of the most significant announcements in philanthropic history. Bill understands scale, Warren murmured to himself, folding the newspaper. And Melinda understands humanity. Together, they'll do more good with this money than I ever could. The decision wasn't sudden. For decades, Warren had planned to give away his fortune, telling friends and shareholders that his children would receive enough to do anything, but not enough to do nothing. But the execution had evolved. Originally, he'd intended to direct his philanthropy posthumously. Conversations with Bill and Melinda Gates had changed his thinking. Give while living, he told his assistant Debbie Bosnick when scheduling the announcement. I've decided the snowball has reached sufficient size. Later that day, he met with a small circle of trusted advisors in the unpretentious Berkshire headquarters at Kiewit Plaza. Charlie Munger, his 82-year-old partner and Berkshire's vice chairman, nodded approvingly from across the conference table. You're doing the right thing, Warren, Charlie said with characteristic bluntness. The Gates Foundation has the infrastructure we lack. Trying to build our own philanthropy from scratch would be inefficient. Efficiency in charity matters as much as efficiency in business, Warren replied, a faint smile crossing his face. Maybe more. The announcement reverberated globally. Fortune magazine estimated the commitment at approximately $37 billion, the largest act of charitable giving in history. What few understood was the deliberate structure of Warren's giving, annual gifts of Berkshire stock that would amplify the foundation's work fighting disease, reducing poverty, and expanding educational opportunities worldwide. By early 2008, the financial markets began showing signs of distress. The housing bubble had burst, credit markets were freezing, and fear was spreading. While others panicked, Warren maintained his disciplined routine. Rising early, driving himself to McDonald's for breakfast, the amount he spent determined by the previous day's market movement, and arriving at his office where Debbie had printed out his emails for review. In September, the situation deteriorated dramatically. Lehman Brothers collapsed, AIG required government rescue, and markets plummeted. Warren's phone rang constantly, CEOs, Treasury officials, journalists, all seeking wisdom or financial support. The economy has fallen off a cliff, he told CNBC in a rare morning interview, his voice steady despite the chaos. But amid the turmoil, Warren saw opportunity, deploying billions in capital to companies desperate for liquidity and confidence. On a cool autumn evening, Warren sat in his living room with his daughter, Susie. I'm worried about what this crisis will do to the foundation's work, Susie said, referring to the annual stock donations that fueled their philanthropic efforts. Warren nodded, understanding her concern. The market collapse had reduced Berkshire's stock price, temporarily shrinking the dollar value of his annual gifts. Yet he remained unshaken. The foundation's work continues regardless of short-term market fluctuations, he explained, his voice gentle but certain. The vaccines, the disease prevention, the education initiatives, they're even more vital during economic hardship. Warren understood the numbers better than anyone. Through the Gates Foundation, his contributions were already helping vaccinate over 120 million children worldwide. Polio, which had paralyzed 350,000 people annually in the 1980s, was now approaching eradication, with cases reduced to just a few hundred. Malaria deaths had begun a dramatic decline that would approach 60% by 2020. Money multiplies when it prevents suffering, he told Susie. Every dollar spent preventing polio saves thousands in treatment costs later, not to mention immeasurable human suffering. The financial crisis deepened into 2009. Unemployment surpassed 10%, foreclosures ravaged neighborhoods, and America's confidence faltered. In Washington, the newly inaugurated President Obama and his economic team worked to stabilize the economy. Against this backdrop of uncertainty, Warren made the boldest acquisition of his career. On a November morning, he sat with Matt Rose, the CEO of Burlington Northern Santa Fe Railway, finalizing terms for Berkshire's acquisition of the railroad. The $34 billion deal, Berkshire's largest ever, would require all of Warren's available cash and even some borrowing. "This is an all-in wager on the American economy," Warren told Rose as they reviewed the terms. "Railroads move goods when America is working." The BNSF acquisition surprised many analysts. Railroads, with their massive infrastructure, regulatory complexity, and labor unions, seemed at odds with Warren's preference for simple, understandable businesses. But Warren saw what others missed: an essential transportation backbone that could not be replicated, moving goods with 4 times the fuel efficiency of trucks across a 32,000-mile network that connected ports, factories, farms, and mines. That evening, Warren played bridge with friends at the Omaha Club, the game that had fascinated him since childhood, providing both mental exercise and social connection. Between hands, the conversation turned to the railroad purchase. "You're zigging while others zag," said one of his bridge partners, a local businessman. "Most are running from the recession, you're running toward it." Warren placed his cards carefully on the table. "When others are fearful, that's the time to be greedy. BNSF will be earning $5 to $6 billion annually in the coming years. The recovery will come, and when it does, we'll be positioned to benefit." By 2010, scrutiny turned toward Warren's 13% stake in Moody's, the ratings agency that had assigned AAA ratings to toxic mortgage securities before the financial crisis. Congressional investigators questioned the inherent conflicts in the ratings industry and, by extension, Warren's investment in the company. Warren sat in his sparsely furnished office, reviewing his testimony for an upcoming Financial Crisis Inquiry Commission hearing. He believed in transparency. It was the antidote to the financial system's opacity that had contributed to the crisis. "Uncomfortable questions deserve thoughtful answers," he told Howard, his son, during a phone call. "I'll explain my investment in Moody's, but I won't defend the indefensible in the ratings industry." Warren began reducing Berkshire's Moody's stake, acknowledging through action what he wouldn't state publicly: the company's business model faced fundamental challenges after the crisis. The position would be substantially reduced by 2012. That spring, as economic recovery slowly began taking hold, Warren prepared for Berkshire's annual meeting, the Woodstock of capitalism, that now drew nearly 40,000 shareholders to Omaha each May. What had started as a small gathering decades earlier had evolved into a financial pilgrimage, complete with a sprawling exhibition of Berkshire-owned companies selling everything from See's Candies to Justin Boots. On the evening before the meeting, Warren dined with his family at Gorat's Steakhouse, his favorite Omaha restaurant. The conversation turned to the foundation's work. "I received a report from the Gates Foundation today," Warren said between bites of his medium-rare steak with hash browns. "The measurable outcomes are remarkable. Vaccine distributions reaching more regions than ever, dramatic reductions in childhood diseases." "It's the best investment you've ever made," said Howard, who ran a foundation of his own focused on global food security. Warren nodded, his eyes brightening. "Returns measured in lives saved rather than dollars earned." He paused, then added, "The snowball effect works in philanthropy too. Each healthy child becomes a productive adult who raises healthier children." The annual meeting itself provided Warren a platform to educate shareholders and the wider world. For 6 hours, he and Charlie fielded questions with a combination of financial acumen, ethical clarity, and folksy wisdom that had become their trademark. A shareholder from Boston approached the microphone. "Mr. Buffett, with your BNSF acquisition and the annual giving to the Gates Foundation, you seem to be making 2 very different bets on the future. Could you reconcile these strategies?" Warren leaned forward slightly. "They're not different bets at all. Both represent optimism about the future. BNSF is a bet on America's economic growth, while the foundation work is a bet on human potential. Both investments compound over time." The answer epitomized Warren's worldview: long-term thinking, compounding returns, and fundamental optimism about human progress. all delivered with Midwestern plain-spokenness that belied his sophisticated understanding of complex systems. As the meeting concluded, Warren returned home to Farnham Street. Despite his wealth and influence, his personal habits remained remarkably constant. He played bridge online, read voraciously, and avoided alcohol. His assistant still printed his emails. He still didn't use a computer. The McDonald's breakfast, the cherry Coke, the newspapers in bed. These routines anchored his days and preserved mental bandwidth for decisions that mattered. That night, Warren sat in his study reviewing Berkshire's quarterly numbers. The company had weathered the financial crisis better than most, but the recovery remained fragile. The BNSF integration was proceeding well. The railroad was already contributing substantially to Berkshire's bottom line. He thought about the annual letter he would write to shareholders in the coming months, his primary teaching vehicle. For decades, these letters had educated investors about value investing, business principles, and ethical capitalism. Now, they increasingly touched on philanthropy and legacy. Warren closed the ledger and gazed out the window at the quiet Omaha street. The modest house, the disciplined routine, the commitment to rationality, these had remained constant across decades. What had evolved was his understanding of wealth's purpose. The accumulation phase had given way to the distribution phase, but both were governed by the same principles: patience, rationality, and compound returns. The game is to maximize human potential, not to maximize shareholder value, he murmured to himself, a variation on thoughts he'd been refining. Though properly understood, they're not as different as people think. In the soft lamplight of his study, Warren Buffett, now widely known as the Oracle of Omaha, continued planning his most consequential legacy. Not the fortune he'd built, but the human potential it would unlock when directed toward humanity's most persistent challenges. The railways would transport America's goods, but the foundation work would transport humanity's possibilities. Both investments in a future he would help shape, but not live to fully witness. The evening air hung thick with humidity as Warren Buffett gazed through the window of his Omaha office, watching shadows stretch across the manicured lawn. The same modest headquarters he'd occupied for decades, the same unassuming desk. Outside, America was slowly recovering from the financial crisis, but here in his sanctuary, time seemed to move at its own deliberate pace. "Mr. Buffett," his assistant called softly. "David Sokol is on line 1. Warren nodded, picking up the receiver with a sense of foreboding. It was early 2011, and something in Sokol's voice had been different lately. Sokol, once considered a potential successor, had been pushing for Berkshire to acquire Lubrizol, a specialty chemicals manufacturer. "David," Warren greeted, his voice measured. "I've been thinking more about Lubrizol," Sokol said, skipping preliminaries. "The fundamentals are solid. It would be a smart acquisition for Berkshire." Warren made non-committal sounds as he listened, jotting notes on a yellow legal pad. What Sokol hadn't mentioned, what Warren would discover later, was that Sokol had purchased nearly $10 million in Lubrizol shares before recommending the acquisition. Later that evening, as Warren drove himself home in his modest car, streetlights casting intermittent shadows across the dashboard, he contemplated the principles that had guided Berkshire for decades. Integrity wasn't just a word framed on a wall, it was the foundation everything else rested upon. "I've always said," he murmured to himself, pulling into his driveway, "that we can afford to lose money, even a lot of money. But we can't afford to lose reputation, even a shred of reputation." The Sokol situation unraveled quickly. By late March, the conflict of interest had become clear. Warren sat in his wood-paneled study, a single lamp casting warm light across scattered papers, and composed a press release with the precision of a surgeon. Sokol would resign. The timeline of events would be transparent. There would be no equivocation about principles. Charlie Munger, Warren's longtime partner and intellectual foil, called as dawn broke the next morning. "You did the right thing," Charlie said, his voice gravelly over the phone. "Integrity is non-negotiable." Warren gazed at the morning newspaper spread before him. "The SEC might not charge him," he said, "but that's not the point." No, Charlie agreed. The point is what we stand for. In the months that followed, Warren found himself navigating unfamiliar territory. For a man who had built an empire by staying within his circle of competence, technology remained largely outside that circle. Yet in 2011, he made an unexpected move, investing approximately $10 billion in IBM. It's not the technology itself I'm betting on, he explained to Becky Quick during a CNBC interview, late autumn light filtering through the studio windows. It's IBM's relationship with enterprise customers. The moat is in the business model, the recurring revenue. At home that evening, he settled into his favorite chair, a financial report open in his lap. The IBM decision had surprised many who knew his historical aversion to tech investments. But Warren saw IBM differently, as a services company with predictable cash flows, not a speculative technology play. Time would prove this assessment flawed. Cloud computing would erode IBM's competitive advantages faster than he anticipated. By 2018, he would sell the position at a modest loss, perhaps $1 billion, a rare misstep for the Oracle of Omaha. The winter of 2014 brought another strategic shift. In his book-lined office, Warren sat across from Jorge Paulo Lemann, the Brazilian billionaire behind 3G Capital. Between them lay spreadsheets detailing the potential merger of Kraft and Heinz. The synergies are compelling, Lemann said, his voice precise, cultured, cost-cutting opportunities substantial. Warren nodded, studying the figures. He admired 3G's zero-based budgeting approach, their ruthless efficiency. But something troubled him, a question of balance between necessary discipline and sustainable growth. The brand value needs protection, Warren cautioned. Cost-cutting can't come at the expense of long-term vitality. Lemann nodded agreement, but his eyes remained fixed on the numbers. By 2015, the Kraft-Heinz merger would be reality, with Berkshire committing approximately $10 billion to the deal. It would later become a point of contention, critics arguing that 3G's aggressive cost-cutting damaged brand equity and underinvested in innovation. Summer rain pelted against the windows of Warren's home study as he read letters from shareholders, many expressing concern about the partnership with 3G. "They think I've changed my standards," he remarked to his daughter Susan, who sat across from him, "that I'm endorsing a slash-and-burn approach." "Have you?" Susan asked quietly. Warren was silent for a long moment. "I believe in operational efficiency," he finally said. "Always have. But perhaps the balance point is different in consumer businesses with emotional brand connections." It was a subtle acknowledgement that even at 85, Warren Buffett was still learning, still calibrating his understanding of a changing world. The popular image of Warren as a technological Luddite persisted through these years, reinforced by his own carefully crafted narrative. "I've never sent an email," went the oft-repeated claim. The truth was more nuanced. He had been using email since the early 2000s, albeit sparingly. The folksy image served its purpose, creating distance between Berkshire and the frenetic pace of modern finance. In late 2016, Warren sat in a comfortable chair in his Omaha home as a documentary film crew adjusted lighting and microphones. The HBO production, Becoming Warren Buffett, would offer unprecedented access to his daily routine. The McDonald's breakfast, the 5-minute drive to the office, the hours spent reading. "Why agree to this now?" asked the director during a break. Warren smiled slightly. "Maybe it's time to leave a more complete record," he said. "The myths tend to overshadow the reality." The reality was both simpler and more complex than the public persona suggested. The man who coined phrases like, "Rule number 1, never lose money. Rule number 2, never forget rule number 1," had, in fact, lost money numerous times. The philosophy behind the quip, the emphasis on risk management, was the true lesson. "Price is what you pay, value is what you get," he told the documentary crew. That remains as true today as when I started. As 2017 approached, succession planning became increasingly important. In his oak-paneled office at Berkshire headquarters, Warren reviewed organization charts with his most trusted advisors. Ajit Jain, the insurance genius who had created billions in value, and Greg Abel, who had masterfully managed energy and infrastructure operations, would both be elevated to vice chairman. The structure needs to outlast any individual, Warren said, his voice soft but certain. Even me. Investment deputies Todd Combs and Ted Weschler were each managing approximately $15 billion in equity portfolios, a real-world demonstration that the investment function could be distributed rather than centralized in one irreplaceable figure. On a crisp autumn evening in 2017, Warren stood by the window of his modest home, watching leaves scatter across the lawn. Nearly 7 decades had passed since he'd bought his first shares at age 11. The world had transformed several times over. Digital technologies had reshaped industries, created new billionaires, rendered once mighty companies obsolete. His phone rang, Charlie Munger calling from California. "I've been thinking about our tech position," Charlie said without preamble. Warren smiled. Their conversations often began this way, as if continuing dialogues that had never paused. "IBM was the wrong horse," Warren acknowledged. "The moat eroded faster than I expected." "The pace of change," Charlie agreed. "We underestimated it." Warren settled into his chair, contemplating the admission. For a man whose investment philosophy centered on recognizing his limitations, staying within his circle of competence, acknowledging when that circle shifted, was itself a kind of wisdom. "The principles haven't changed," Warren said. "Find businesses with durable competitive advantages, honest management, reasonable prices. But the world the principles operate in, that changes constantly." After hanging up, Warren returned to the window. Somewhere in Omaha, a young investor was probably studying his methods, memorizing his quotes, trying to distill decades of experience into actionable wisdom. He hoped they understood the most important lesson, that humility before markets was the beginning of investment wisdom. The folksy, accessible persona he had cultivated served its purpose. It made complex financial concepts approachable. But behind the aphorisms and anecdotes stood a man still wrestling with the fundamental questions of value, still adapting to a world that refused to stand still. As darkness settled over Omaha, Warren Buffett closed his book and turned off the lamp. Tomorrow would bring new challenges, new opportunities, new mistakes to avoid. The game remained the same, even as the players and pieces changed. Find value where others missed it. Think independently. Take the long view. And never, ever forget rule number 1. Warren Buffett stood at the window of his office in Kiewit Plaza, gazing out at Omaha's skyline as a gentle snow began to fall. It was December 2020, and the world outside had changed dramatically in the past year. The streets were quieter, the usual bustle tempered by a pandemic that had reshaped how people lived, worked, and invested. He took a sip of cherry Coke, his beverage of choice for decades, and adjusted his wire-rimmed glasses. At 90 years old, he had witnessed market cycles, crashes, recoveries, and transformations. But the past year had challenged even his storied experience. "You still thinking about the airlines?" Greg Abel asked, entering the office with a stack of reports. Warren nodded slightly, his expression thoughtful rather than troubled. 4 companies, gone from our portfolio in a matter of days, not my finest hour. The decision had come during the early chaos of the pandemic. With borders closing and travel grinding to a halt, Warren had sold Berkshire's entire position in 4 major airlines, Delta, American, Southwest, and United, at near bottom prices. The stocks had since recovered significantly. "We've all been wrong before," Greg said. "The mistake wasn't selling," Warren clarified. "The mistake was buying in the first place. I've spent decades avoiding businesses that require continued massive capital expenditure just to stay competitive. Yet I convinced myself the industry had changed." He picked up a newspaper from his desk, still preferring the tactile sensation of newsprint over digital screens, and scanned the headlines. Despite his age, he maintained his habit of reading 500 pages a day. "The virtual meeting went well," Greg observed, changing the subject. 35,000 viewers, even with the empty arena. Warren nodded. The 2020 Berkshire Hathaway annual meeting had been unlike any in its history. No crowds filling the CHI Health Center, no shareholders lining up at 5 a.m., no exhibition hall showcasing Berkshire's many businesses. Just Warren and Greg in an empty arena, answering questions via video link. I told them exactly what happened with the airlines, Warren said. When the facts change, I change my mind. And I was wrong. This public admission wasn't calculated. It was simply who he was. Throughout his career, Warren had maintained that transparency built trust, and trust was perhaps the most valuable currency in business. Later that evening, Warren drove his Cadillac XTS through the familiar streets toward the house on Farnham Street, the same modest home he had purchased in 1958 for $31,500. Despite a net worth that fluctuated between $130 billion, making him among the 5 wealthiest people on the planet, Warren saw no reason to upgrade. The 5-bedroom house had served him well for over 60 years. As he pulled into the driveway, his mind was on Apple. What had begun as a relatively modest position in 2016 had grown into something extraordinary. Berkshire now owned approximately 915 million shares, worth around $170 billion in 2024. It represented nearly half of Berkshire's public equity portfolio. Inside, he settled into his favorite chair and opened his well-worn copy of the latest financial statements. The numbers told a story of astounding scale. Berkshire's A shares trading near $650,000, book value per share around $580,000, annual revenue approaching $370 billion, operating earnings near $40 billion, and roughly 390,000 employees across more than 60 wholly owned subsidiaries. He picked up the phone and dialed a familiar number. "Charlie," he said when his longtime business partner answered. "How's California treating you?" Charlie Munger, at 96, remained Warren's intellectual sparring partner, confidant, and the vice chairman of Berkshire Hathaway. Their partnership had spanned over 6 decades. "Warmer than Omaha, I expect," Charlie replied in his characteristically terse manner. "I've been looking at the Apple position again," Warren said. "Good business, great moat, not even really technology. It's a consumer products company with an ecosystem." This had been Warren's essential insight, seeing Apple not as a tech company that would inevitably be disrupted, but as a consumer brand with extraordinary loyalty and pricing power. Similar to Coca-Cola, which had been one of his best investments since 1988. "Tim Cook understands capital allocation," Warren continued. "The buybacks are reducing share count significantly." "Better than dividends for us," Charlie agreed. "Tax efficient." Warren nodded, even though Charlie couldn't see him. Apple's aggressive share repurchase program meant that Berkshire's ownership percentage increased automatically over time, without requiring additional investment. After they hung up, Warren reflected on how far they'd come. When he'd started his partnership in 1956 with $105,000, he could never have imagined controlling a conglomerate with $300 billion in cash and treasury bills, waiting for the right elephant-sized acquisition to come along. The following morning, Warren sat across from his wealth advisors, reviewing the structure that would eventually distribute his fortune. "The instructions are clear," he said. 90% in an S&P 500 index fund, 10% in short-term treasury bills held in trust for my wife. The rest goes to the foundations as planned. Despite being perhaps the greatest active investor in history, Warren had long advocated index funds for most investors. His own family would largely follow this passive approach after his passing. "And the succession plan for Berkshire?" one advisor asked. "Greg Abel will be CEO," Warren said definitively. "That's been announced. Ajit Jain will continue overseeing insurance operations. Todd and Ted will manage larger portions of the equity portfolio." He had carefully assembled this team over years. Greg Abel, who had proven himself running Berkshire Hathaway Energy, Ajit Jain, whose insurance acumen had helped build Berkshire's massive float to approximately $164 billion by 2023, and investment managers Todd Combs and Ted Weschler, who had gradually taken over portions of the equity portfolio. Warren stood and walked to the window again. Below, Omaha continued about its business, largely unaware of the decisions being made. Below, Omaha continued about its business, largely unaware of the decisions being made that would affect one of America's largest companies. "The culture will outlive me," he said, more to himself than to those in the room. "That's what matters: rationality, integrity, long-term thinking." In the spring of 2021, Warren prepared for another annual meeting, reviewing the letter he had just sent to shareholders. The pandemic continued, though vaccines offered hope for eventual normality. The meeting would again be different, held in Los Angeles rather than Omaha, allowing Charlie Munger to participate without traveling. But the format would remain the same: straight talk about business, investments, and the state of the company and the world. As he worked through the morning, Warren's assistant brought in the latest financial reports. Berkshire's investment in Apple had continued to appreciate, now representing approximately 47% of their public equity holdings. Some critics had questioned this concentration, arguing it violated his own diversification principles. But Warren saw no contradiction. "Diversification is protection against ignorance," he had often said. "It makes little sense for those who know what they're doing." He picked up the phone again, this time calling his daughter Susan. "How are things at the foundation?" he asked, after they had exchanged pleasantries. "Good," she replied. "The focus remains on early childhood education and health." Warren nodded with satisfaction. His 3 children, Howard, Susan, and Peter, each ran foundations funded by his wealth. They would receive staged gifts of Berkshire stock over time, not for personal consumption but for philanthropy. The majority of his fortune would go to the Bill and Melinda Gates Foundation, focusing on global health and development. "Dad, are you still playing bridge online?" Susan asked. Warren chuckled. "About 12 hours a week. Keeps the mind sharp." After they hung up, he returned to his work. Despite his wealth and influence, Warren's daily routine remained remarkably consistent: reading, thinking, analyzing businesses, and making decisions based on facts rather than emotions or trends. In the fall of 2023, Warren received the news with stoic sadness. Charlie Munger had passed away at 99, just shy of his centennial birthday. They had last spoken a few days earlier, discussing a potential investment opportunity with the same clarity and intellectual rigor that had characterized their conversations for decades. Warren sat alone in his office, memories flowing through his mind. Their first meeting in 1959, Charlie's push toward quality businesses in the 1970s, countless meetings and decisions made together. Charlie had been his intellectual ballast, his sounding board, the man who had helped transform Warren from a Graham-style cigar butt investor into someone who appreciated the value of wonderful businesses at fair prices. "Take the high road," Charlie had often advised. "It's less crowded and the view is better." Warren smiled at the memory. Charlie's witticisms, Berkshireisms, as shareholders called them, had become legendary at their annual meetings. The phone rang, interrupting his reverie. It was Jamie Dimon, CEO of JP Morgan Chase. "Warren, I just heard about Charlie. I'm sorry." "Thank you, Jamie. 99 years well lived." They spoke briefly about Charlie. Then the conversation turned, as it inevitably did between them, to business and markets. "The cash position is substantial," Jamie observed, referring to Berkshire's approximately $300 billion in cash and treasury bills. "Waiting for the right elephant," Warren replied, using his favorite metaphor for a major acquisition. "Valuations are still challenging." After the call, Warren pulled out a notepad and began jotting thoughts for the next annual shareholder letter. At 93, he remained sharp and engaged, still showing up daily at the office, still reading extensively, still making the crucial decisions that guided Berkshire Hathaway. By early 2024, with his 94th birthday approaching, Warren found himself reflecting more frequently on legacy and succession. The annual meeting was being planned. Expected attendance around 35,000 shareholders coming to Omaha for what some called Woodstock for capitalists. He sat in a meeting with Greg Abel, reviewing the latest numbers across Berkshire's businesses, GEICO's insurance operations, BNSF Railways freight volumes, Berkshire Hathaway Energy's renewable investments, and dozens of smaller wholly owned companies from See's Candies to Dairy Queen to Precision Cast Parts. The operating earnings are strong, Greg noted, pointing to figures approaching $40 billion annually. Warren nodded. The structure works, decentralized operations with centralized capital allocation. This was the essence of the Berkshire model. Let exceptional managers run their businesses with minimal interference, but keep control of the capital, allowing it to flow where it could generate the highest returns. The Apple position continues to perform well, Greg added. Warren smiled slightly. The investment, now worth approximately $170 billion, represented his evolution as an investor. He had missed Microsoft in the 1990s, despite his friendship with Bill Gates, because he felt he couldn't predict technology trends. But with Apple, he had seen something different, not a tech company, but a consumer ecosystem with extraordinary brand loyalty. The moat is wide and getting wider, Warren observed. The installed base, the ecosystem, the switching costs, it's Coca-Cola for the digital age. After the meeting, Warren drove to Gorat's, his favorite steakhouse in Omaha. He ordered his usual, a medium-rare T-bone with a cherry Coke, and considered the road ahead. Berkshire was prepared for succession. The culture had been built to last generations, what the Japanese called IN forever. The philanthropic structures were in place to distribute his wealth effectively. The company owned solid businesses with durable competitive advantages. The cash position provided optionality for opportunities that might arise. What more could he accomplish in his remaining years? Perhaps one more elephant-sized acquisition to deploy a significant portion of Berkshire's cash. Perhaps further refinement of the succession plan. Perhaps additional lessons shared through his annual letter. As he finished his meal, Warren thought about the epitaph he hoped to eventually earn, teacher who lived what he taught. Not world's greatest investor or richest man, but teacher. Someone who shared wisdom, demonstrated principles, and left the world better informed than he found it. The snow had stopped by the time he left the restaurant. Driving home to Farnham Street, Warren passed buildings and businesses that had been part of Omaha's landscape for decades. Some had evolved, others had disappeared. The city, like markets and economies, changed continuously. Yet certain principles remained constant: integrity, rationality, patience, continuous learning. These were the values Warren had built into Berkshire's culture, the values he had demonstrated throughout his career, the values he hoped would outlive him. As he pulled into his driveway, the same modest house, the same quiet street, Warren Buffett, worth more than $100 billion, thought not about wealth but about impact. The snowball he had started rolling in his youth had grown beyond any reasonable expectation. Now the question was how far it would roll after him and what mark it would leave on the landscape of American business. Absolutely. Here's a cinematic outro for your Richie Rich Stories Warren Buffett episode, written in the same luxurious narrative tone as the intro. It's placed for a slow, reflective ending, about 45-60 seconds, perfect for fade-out visuals, light piano, and your channel's closing branding. In a world obsessed with speed, Warren Buffett became rich by slowing down. He proved that patience can outlast panic, that calm thinking can beat chaos. His wealth was never built on secrets or shortcuts, but on the quiet confidence that value will always reveal itself in time. For Buffett, money was never the goal. It was the scoreboard of good decisions, the reward for discipline, not desire. While others chased trends, he built principles. While others sought luxury, he found comfort in simplicity. From the Great Depression to the digital age, his compass never changed. Be fearful when others are greedy, and greedy when others are fearful. That single idea turned $1,000 into billions, and made him a legend who outlived every market cycle. So the next time the world tells you to hurry, remember the man in Omaha, reading alone at his desk, who showed that wisdom compounds just like money. Because in the end, Warren Buffett didn't just master investing, he mastered life itself. Thank you for watching Richie Rich Stories. If you believe in building wealth the Buffett way, with patience, purpose, and principle, subscribe, share this story, and keep chasing true riches, knowledge, time, and peace of mind. Let us know your thoughts about Warren Buffett and his story in the comments.